I know Wells Fargo cleared out trades yesterday. John, what you do is you sum up all those little ones. It's going to be a big number.
It's going to be a massive number, Lisa, and the number just keeps getting bigger and bigger as the hours come through.
And there's a question, Jack, come on in here with the government response, because they are looking at potential regulation of the banks, or potential regulation of some of these over-the-counter derivative trades that have gone unseen until now. How real is that? What is the timeline there?
The timeline is definitely delayed. To be honest, the talk in Washington right now is so focused on this next big legislative initiative. In terms of banking, there is a progressive push in sort of finance policy. There's definitely a progressive push to look at this. But the timeline is, it sounds like not particularly soon in Washington.
And Jack, when you say that there's a push to look at this, I gotta say, at a certain point, people say, of course they're gonna look at this. It makes them look good to say, okay, now we're gonna have a hearing and we'll bring some people in and we'll talk about it and we're doing something. Is there anyone who actually is talking concretely about perhaps creating more disclosure around these over-the-counter trades in particular that do allow places like Archegos to go holding substantial portions in certain equities without reporting it in any venue?
To be honest, I'm sure there are lawmakers who have brought up specifics along those lines. The question, though, in Congress is, do you have a bill that can move forward in both chambers? Do you have a legislative vehicle? At the top levels, I haven't heard of movement or a schedule that looks to be very close right now.
Jack, always good to see you, sir. A lot of topics to get through down in D.C. Jack Fitzpatrick there of Bloomberg Government. Certainly the spending plans rattling this Treasury market just a little bit more. Yields higher this morning. But we have to turn back to something Eric Schatzker was talking about earlier this morning on Bloomberg TV and radio, Tom. Is it conceivable that prime brokers didn't know, were unaware of the size and leverage being built up elsewhere with other prime brokers? And if they didn't know, why not? And if they did, what on earth were they doing?
John, cardinal versus ordinal. Of course they knew there was leverage being built up, but you don't know the dollar amounts, and you don't know almost the game theory of 5 or 6 or 7 prime broker players, of which are dominant. Clearly, and I suggest this is an amateur, Goldman Sachs and Morgan Stanley were dominant, but the others were all part of that mix, and you don't know that math.
And Lisa, just building on that, how a hedge fund built up these massive stakes in companies without ever needing to disclose what they own, because A, they aren't technically a hedge fund, and B, they don't technically own the underlying stock. That is where the regulator is going to take a closer look, I assume.
And to your point about why the banks would get involved in this, it's more lucrative to have these over-the-counter derivatives. So frankly, they were earning more money at a time when it seemed like a free-for-all, and it seemed like the Fed was backstopping all risk. This is why I keep saying, at a certain point, if you start getting markets normalizing and you start getting pockets of sell-offs, at what point, given the fact that there's already been so much leverage built up, are we going to get other accidents just like this, John?
Alongside Lisa Bravis and Tom Keene, I'm Jonathan Ferro. Much more on this story coming up through the morning, and on geopolitics as well, with George Friedman, Geopolitical Futures founder and chairman. From New York City this morning, good morning to you all. Equity futures unchanged on the S&P 500. Treasuries lower, yields higher, 176.53 on 10s. Yields are up by almost 6 basis points this Tuesday morning. This is Bloomberg Surveillance.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Live from New York City for our audience worldwide, this is Bloomberg Surveillance, and here's the price.
Hello, ladies and gentlemen.
Just compare and contrast.
Hope you're okay today.
Pending doom and gloom.
Right straight to the investment. I'm looking to buy Swiss franc. So if you like to place a trade, the price I placed 0.94,183. So I'm looking to buy at 94,183, and it's right now price executed. So I was filled. All of you guys, you still have a chance because the price moved lower. So you can have chance to buy Swiss franc. So if you'd like to follow this trade, please do so. And just follow the trade, and I'll let you know later on what we're going to do with this pair. Okay? Stay safe. I'll speak to you later.
This morning.
Into the jobs report. This is important, folks. DXY, the blended index there of major trading partners, showing new U.S. dollar strength off of euro weakness. And as John mentions, yen, we're getting used to a 110 weaker yen over the last couple of weeks. I'm pleased to announce my book of the summer, Unforgivable, as we end March and go into April. And is no surprise to anyone who knows me, it's Ackerman and James Trevitis's wonderful 2034. It is the most humble book, generating humility, I've read in years and years and years. I'm not going to tell you about it. Just read it. George Friedman knows this book because he knows the story. He is Geopolitical Futures founder and chairman as we look at what he calls a summer of China. George Friedman, what will be our relationship with China come Labor Day of 2021, or for that matter, Labor Day of 2034?
Well, 2034 is hard to predict. Labor Day is pretty much going to be what it is right now. What's right now is the United States, the Chinese are terrified that the United States will close off the choke points that the Chinese face in shipping to the world. They want the United States to back off. They're posturing, but they really don't have the military capability of pushing the Americans off. And if they try and fail, they have an internal crisis of massive proportions. The risk of trying military action is always that you're going to fail, and then it's not good.
Do we know the intelligence? This is what you're expert at, George. You know, Dr. Friedman, you own the high ground on this. We grossly underestimated Soviet Union strength, or rather, we overestimated Soviet Union strength. Do we have knowledge of Chinese intelligence and defense apparatus?
Yeah, and I was just reading a report yesterday about how the Chinese are viewing the situation. The Chinese are saying that The great threat to any action by China is American submarines, and they are saying that their anti-submarine capability is not very good. So if they were, for example, to invade Taiwan, the first invasion is not the important thing. How do you supply forces in Taiwan across 100 miles of open water? The U.S. has a number of options, particularly submarines. The Chinese don't know what we would do, and that uncertainty makes it a very risky operation. So there's a lot of talk in the newspapers and a lot of speculation on what can be done, but you're a Chinese leader, you want to be very, very careful taking on the United States.
Well, George, how seriously are you taking the prospect that they could invade Taiwan?
Well, they can probably force a landing in Taiwan if they wanted to. I don't see how they supply the forces. In any amphibious assault, it's not the initial attack that matters, as we learned in Omaha Beach. It is getting inside and then day after day after day supplying all the things they need. Can they maintain, in the face of the U.S. Navy and Air Force missiles, can they maintain that line of supply? And the Chinese probably can't, and I think the Chinese know it. But the more they can create an atmosphere in which they are intimidating the United States or appear to be intimidating it, the more they get political benefit. But they have been very cautious not to engage the U.S. military.
George, for many people, including some that come on this program, it feels like these two superpowers are now on an inevitable collision course, and the only thing we can control right now is the pace when it happens. Do you think we can change course?
Well, I mean, the course is speaking loudly and carrying a small stick. The course here is that the Chinese understand the power of the United States. They want to diminish it in public, but at the same time, they have made no military moves whatsoever that would bring them into conflict with the United States. They know there are limits to what the U.S. can tolerate. They also don't underestimate U.S. naval power. The newspapers, the media may underestimate it. Certainly the U.S. Navy wants to emphasize how weak they are so they get more budget. But the fact is, nothing has happened. And nothing has happened because the Chinese don't want it to happen.
This is important, George. You're basically implying here that the chance of a military altercation between the U.S. and China is a lot less than many people seem to think, which raises a question. What is the battlefield? Is it cyber? Is it trade? Is it something else that we haven't necessarily thought about?
China is the largest exporter in the world. The United States is the largest importer in the world. The Chinese have managed through clumsy diplomacy to really irritate its largest customer. China has got to get that market back opened. It doesn't have domestic demand enough to maintain itself, and other countries can't substitute for that American market. So this is about the fact that China does not want to open its markets. The United States is not going to allow the status quo ante to exist, and therefore the Chinese have to find some way to accommodate their economy to the demands of the United States. War is not among them.
You know, I got to say, the deficit in trade between the U.S. and China has only widened during the pandemic. What makes you think that that the Chinese are actually at risk of losing some of their dominance over global trade?
Well, I don't know what the dominance is of the global trade. We have a country with a $14 trillion GDP and 1.5 billion people facing a country with $20 trillion and a population of only 300 trillion. It's hard to see that. But we have to also remember something else. There's a massive alliance arrayed against China. Japan, South Korea, Taiwan, the Philippines, Indonesia, Singapore, Australia, now India. China has not a single military ally in the region, not one. The only ally it has in the whole world that signed the paper is Pakistan. So China is an isolated country, a very vast country that's isolated. But the United States has an alliance structure stretching all the way from the Aleutians to the Malacca Straits. So from a strategic standpoint, the United States has a much better position than the Chinese do.
And Dr. Friedman, this is so much what I see with Kishore Mahbubani of Singapore, where Ambassador Mahbubani talks about is China won, and he says, no, they haven't. Let's get discreet here, and let's look at north of the Philippines to Taiwan, the 100 or so miles of the Luzon Strait. Do we show the flag in the Luzon Strait? Do the French run their military hardware through the Luzon Strait? How do we make clear to China that the Luzon Strait is untouchable?
The Chinese have no illusions about that. The Chinese understand, firstly, that if they did invade Taiwan, the entire alliance structure, the Japanese, the South Koreans, they would turn against them even harder than they have. They understand that hostile military action will panic the region, make the coalition even stronger, and that they've got some, the Japanese have significant naval power. So they understand that taking Taiwan, for example, first, doesn't solve their strategic problem. There are choke points behind Taiwan that the U.S. can close if they succeed. And secondly, if they do undertake this, same reason the Soviets really didn't want to do anything in NATO, because they would solidify NATO. Even the French would join in. So nobody wants the Chinese to rampage across the Pacific. They don't have the ability to do so since they have no allies. They're all alone in the system. But they have to create an atmosphere in which people dread China because it helps their negotiating position, they think. I think it doesn't, but that's for them to decide. But the execution of an amphibious invasion is the hardest thing in military affairs. It was extremely hard for the United States during World War II. It is very difficult. And to remember one thing about any invasion, you can lose. And China internally, where Xi has many questions being asked about his capability in running the country inside the country, he can't afford to lose.
Doctor, a really important conversation, and as always, enjoy catching up with you. George Friedman there, Geopolitical Futures founder and chairman. Number of the moment, we need to turn back to it, 177.42. That's your intraday high at a 10-year yield. Right now, yields up by 6 basis points to 177, Tom. On a 30-year, we're at 245 and up 4 basis points on the day.
To Global Wall Street watching, and really to those that are less Global Wall Street, the key word today, John, is correlation. It's all locked in together, and with futures that are saying to me they want to go higher, even though right now red and green on the screen.
Payrolls Friday, Lisa, the numbers are huge. 650,000 is the median estimate. 1.1 million, Ian Shepherdson over at Pantheon. 1 million, Michelle Meyer over at Bank of America. I think Michael Gapin of Barclays in and around 950. These are big numbers people are looking for this coming Friday.
And it raises a question of whether we're going to see further disruption in the Treasury market as people get accustomed to a booming economy at the same time as President Biden plans to talk about a $3 trillion stimulus. You put these things together, how much disruption do you get in markets that have gotten used to incredible policy support and very low yields?
And what's so important here, John, is we can introduce for Tuesday, Wednesday, Thursday, on to Jobs Day Friday. I'll be here, folks. Good Friday. Pharaoh will be off, I should point out. Looking forward to that.
Is that why we're
John,
doing that?
It's the pendulum of boom.
The pendulum of
pendulum
boom.
of boom.
When Lisa starts talking about the pendulum of boom, I think we should all worry.
Then go straight to triple leverage cash right away. I'm not getting there yet.
Not yet. The outlook's better on the vaccine front too. 90% of U.S. adults set to be eligible for a vaccine by the middle of next month, according to the president. We'll have that conversation next with Dr. Amish Adalja, Johns Hopkins Center for Health Security Scholar. From New York City, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Biden is planning to take on the nation's challenge of inequality with a mass expansion of government spending. The president also plans a revamp of the tax code. He'll start to outline his plans tomorrow in a speech in Pittsburgh. The president's remarks will lay out the infrastructure part of a $3 trillion spending package. Social spending programs will be unveiled next month. The immediate crisis of the Suez Canal blockage has ended, but the battle over damages is just beginning. It's estimated that the cost of the canal's closure was $10 billion a day. Cargoes were delayed for days, if not months, and that's likely to lead to a flood of claims by everyone affected, from the shipping lines to manufacturers and oil producers. BioNTech has now raised the number of coronavirus vaccine doses it plans to make this year by 25%. The new target, 2.5 billion doses. BioNTech and Pfizer collaborated to develop the vaccine. BioNTech estimates that in the fourth quarter it took in $405 million in revenue versus $33 million a year earlier. And a battle in the Supreme Court tomorrow could determine whether the NCAA's grip over college athletics is loosened. The organization will ask justices to overturn a ruling that would let member schools offer student athletes more in the way of education-related compensation. The NCAA is trying to shield its rules from tough antitrust scrutiny. The US is abandoning its 4-year-long antitrust.
Okay, guys, let's place stop on profit, and let's place stop on profit at 0.94383. Okay, 0.94383. 18. Sorry, we need to get more precise. 0.94. We will place a stop on profit at 0.94. 198. That's a nice level. That will probably hold for a while and keep us going on. If the price will change direction, we have a chance that it will not reach this level. Okay? Okay, if you follow this trade, if you already entered this trade, please place stop on profit so you will not lose your investment money, and if it changes its direction, you will end up in profit. Okay? Stay safe. I'll speak to you later.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Okay, guys, position closed at 0.94198. You already received confirmation from your broker. And, you know, it all depends how much you invested. If you trade in on margin, in our case, we received £150 in profit. In your case, it's all about how much the broker pays you per pip. Okay, let me show you where we close trade for newbies, for people who just decided to follow or trade. And let's look for other chances and opportunity where we can invest. We still hold several positions on, as you can see from our blue line, our ticker on Japanese yen, on euro. So we're still into several trades. Okay, stay safe.
We mentioned earlier, Bitcoin 59,000 right now. This is a joy, and it is a joy, John Farrow, after seeing the success of the United Kingdom in limiting deaths from this pandemic. No one like the United Kingdom has done this. America, better statistics, no question about that. Others, grim. John, what's your take on why the United Kingdom has been so successful?
The strategy was different. They prioritized one shot over getting everyone two within the time of maybe a month, Tom. They prioritized one shot, and right now the numbers are pretty staggering. 34 million doses given, enough to cover the population of about 25.5%. Get into second doses. That's where the push really begins in the last couple of weeks.
So the second dose is the focus in America. Amish Adalja with us with Johns Hopkins Center for Health Security, senior scholar, and of course his work really across all of the media in sending the message on this pandemic. Dr. Adalja, please explain to me how science-based pros like you, and frankly like Bill Nye, the science guy, how are you going to get the message of the efficacy and safety of this vaccine out to good Americans who just are scared and uncertain? How do you do that?
It's very challenging because the data speaks for itself. If you look at the clinical trial data, it's really incredible. We really don't see vaccines with this type of efficacy every day. But I do think what will happen is as more and more people get vaccinated, as people see the benefits of the vaccine, their friends, their family members getting vaccinated, nothing bad happening to them, but only good things happening, meaning they get their life back. They get different privileges as people start to say vaccinated people can do this safely. All of that, I think, is going to push the needle. Every day, as more people get vaccinated, I think the case on our side for advocating for this vaccine gets better. But we know that vaccine hesitancy is going to be something that we have to battle. We have to be proactive about. There are still a lot of misinformation about this vaccine out there. It's very challenging, but all we can do is really meet people where they are and try to assess their risks and try to figure out exactly what they need to hear and show them the data that supports that. It's just a challenging thing, though.
Dr. Adalja, you talk about updated guidance from the CDC of what you can do once you get vaccinated. Can you talk about what you expect that updated guidance to be, given the fact that people already are operating as though they have full immunity, both with respect to contracting the virus and spreading it once they get vaccinated?
This is why I was worried about the CDC guidance being overly cautious, because it's going to lag what people are doing. I think what the next things that will probably happen is they'll probably remove that 3 months after post-vaccination. They'll say, if you're vaccinated, this is what you can do. I expect likely that there's going to be a change on the non-essential travel, that they'll say, if you're fully vaccinated, it's okay to travel. That was one thing that many people wanted to see. And then I also think there's going to be more data on this asymptomatic spread. If you look at the new study that came out yesterday, that was a CDC-sponsored study in healthcare workers, we see not only do the vaccines protect you from getting symptomatic or severe disease, but they also protect you from getting infected at a very high rate. So I think there's going to be guidance changes there. You may also see guidance for people who've had prior COVID infections going down to 1 dose. There's more and more data, including that same study from yesterday, showing robustness with one dose. So I think that's going to be something you may see happen soon as well.
And when it comes to the number of shots, John was talking about how in the UK they've taken an approach of just prioritizing one shot and then worrying about the second shot later. New studies coming out showing that people do have about 80% protection after the first shot several weeks. What do you make of that? I mean, is that basically edification of what the UK has done?
I think it is. And I think people had made this one-shot, two-shot controversy into kind of a war when it really didn't need to be. It wasn't about completely ignoring the second shot. It's let's just deprioritize it and we'll catch up at the end. We'll mop up with the second dose, because getting people from 0% immunity to 80% immunity is a major feat, and you will see benefits. And I think that's a strategy that the UK pursued, and they pursued it very successfully. It's something I think we should have considered a little bit more than we did. Not that we were going to just basically trash the study and say we're not going to give the second dose ever. It's just get the second dose, get it in somebody later when we know supply is more plentiful, but get people from 0 to 80% much faster. And I think we probably could have been a little bit farther along if we would have done that.
Where is supply right now? I get confusing signals. As we wake up in all the cities across this nation, what is the supply of the vaccine?
I'd say it's very much better than what it had been in earlier months, and it's only going to get better. We know that Johnson & Johnson is going to be delivering a lot of vaccines in the coming days if they haven't already delivered it. We know that the Pfizer and Moderna vaccine supplies are becoming plentiful. We're seeing vaccine clinics kind of springing up, and it seems to be going very well. I think that we knew everything was kind of backloaded. In the very early days, it was going to be difficult to get vaccine to places, but now it seems to be a steady stream. And I think that as long as we keep up this pace and even go faster, 2 million, 3 million doses a day, we'll be in good shape.
Amish, always good to see you. Dr. Adalja, thank you, sir. Johns Hopkins Centre for Health Security, senior scholar. This after London. Guy Johnson telling me yesterday, Tom, that London recorded 0 deaths from COVID over the weekend. The first day we've seen that in 6 months. And it's the cases, the death cases we need to focus on. That's where we're really starting to see the vaccine effort bite.
Shout out to James Burns Murdoch over at the FT, who's really got beautiful charts showing the challenges. As we mentioned, the good news here across the Atlantic, we should also note Brazil hugely challenges. Albert Coe of Yale University told us yesterday. John, can I mention a bank we're not talking about?
Of course you can.
Are we not talking about J.P. Morgan? Why are we not talking about J.P. Morgan? I mean, they're in the prime business, right?
That's the good news for J.P. Morgan, isn't it, Lisa? That we're not talking about J.P. Morgan.
We're not talking about J.P. Morgan.
We're not talking about Bank of America.
Yes.
If you're not being talked about in the last couple of days, that's a good thing.
That's a good
And
thing.
if you take a look at the share prices ahead of the open today, you can see that they're up because you see the 210s gap in the yield curve is actually the widest since 2015. They can benefit because there isn't a concern that they've lost $1 billion based on this potential exposure.
John, it's the pendulum of diamond.
The pendulum of diamond.
What it is.
Oh my God. How far are we going to take this?
We need to talk about this, and I think the reporting is going to reveal this in the weeks still to come. Why JP Morgan wasn't part of that massive competition for the same client when many other banks on Wall Street were, Tom.
It's going to be each individual story. There'll be some great reporting, including Sri Anatarajan with us and others. Tracy Alloway, I thought, was brilliant yesterday with her team in Asia. You know what, John? It's all going to come out. It's going to be a movie. Lisa's going to be in the movie.
I look forward to that.
Is that right?
I
can just see her poolside at the Sunset Tower going, okay, I'll be in it.
Just banging the door down at Archegos. Let me in.
Show me the money.
Let me in. I could have told you this would happen. Stocks don't just go up. Futures down 5 on the S&P.
Gloom.
That Norway sells way more electric cars per capita than the U.S.? Norway. Well, I won't stand for it.
In this neighborhood just outside Oslo, the majority of cars are electric.
Last year, Norway became the first country in the world to sell more electric cars than any other.
In December, EV market share was at 67%. In 2025, the country wants all cars sold to be zero emission.
Hey, Norway, listen up, you fish-loving... Oh, this place is adorable. Damn it.
But why is Norway leading this development? The country is rocky, it's ice cold, and with huge distances. The easy answer is politics. By giving the consumers benefits that pay off, more people will go electric when they're getting a new car. These perks could be no VAT when buying the car, reduced tolls, the possibility to drive in the bus lane, and quite a bit of free parking as well. 2021 is an election year in Norway, and the Climate and Environment Minister Sveinung Rotevatn believe the EV perks will be a hot topic in the campaigns, where removal of the perks is set to be a central issue.
Television exclusive, a conversation with Baidu co-founder and CEO Robin Lee.
We're far from done. We will continue to invest for the next 10, 20 years.
Watch the full interview only on Bloomberg Television.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is an unwind of a levered position. I think in this sort of an environment, it is tempting to kind of transform it into a catastrophic financial market-wide situation.
I think we're about 4 to 6 weeks away from just this economy just completely reopening and taking off.
We have to be conscious of the fact that the vaccine alone and the COVID story alone does not tell the whole story.
This is going to build to a lot of momentum as this year goes on. So I think the environment is going to heat up a lot.
The hardest thing about monetary policy is sometimes
they're pretty frustrated, they're indignant. Many Spaniards were resigned really to an Easter at home after the rules brought in that there would be the closure of all the regions in Spain, but they knew that they would see French and German tourists in particular still coming in to places like Madrid and the Balearic Islands has caused a lot of indignation, particularly as we're in a Madrid local election campaign. Some of the politicians on the campaign trail have started talking about drunken French people being encouraged by the Conservative Madrid regional leader to come here to visit. The head of a tourist association that is particularly powerful has talked about this being a Kafkaesque state of affairs. He said that it was surreal, Kafkaesque, that somebody who lives about an hour from Madrid in Avila wouldn't be able to come to the Spanish capital, but a German could go to Mallorca, and he said it was a strange situation indeed, that theoretically somebody living in Avila could actually get to Mallorca via Germany. Now, the government has defended that state of affairs, has said that that is because the European Commission has recommended EU states keep their borders open and that those from European countries can travel theoretically to other European countries as long as they respect the local COVID
does good news become bad news for markets as we see the rise in yields really pressure some of the more leveraged positions across markets?
Well, right now they're comfortable, and they have been for a while. Here's the price action this Tuesday morning. Yields are higher, the curve is steeper. Your 10-year up 5 basis points to 176. Your 30-year up 3 basis points to 244. Outside of that, in foreign exchange, dollar yen has a 110 handle. We'll touch on that a little bit later. Euro dollar 117. just about. As Tom points out, 116 could be just around a corner. 117.32 right now, down a third of 1%. Outside of all of that, there's the equity market, Lisa. It's a mild move, but we carry on rolling over just a little bit over the last 20 minutes. We're down 0.2% on the S&P.
And this comes on the heels of higher yields, although, again, very much stable when it comes to the pace of the move. I am so curious for 9 a.m. today. The Fed's Randy Quarles will be speaking at a financial stability conference. And how much is the Fed worried about the consequences of their ultra-low rate policies for this long, especially in light of a booming economy? Yes, this is good news, but don't worry, Tom, I still have some gloom. There is concern that higher rates will push some of the leverage out of the system, as we saw with Archegos, although perhaps not to the same degree. Then at 10 a.m., more good news. Potentially, we're going to get that March consumer confidence data. We're expecting a third straight month of an increase in this. Of course, people are feeling better if they can get inoculated and they can go on vacation. They can finally start living lives that they remembered once enjoying. And then at 2:30 p.m., more Fed speak. We're going to be hearing from New York Fed's John Williams. This is the key issue. And John, you raise his background as an economist, not as a market specialist, and how that's been a point of controversy. What is the New York Fed seeing in terms of the leverage buildup, in terms of the potential risk of a disorderly unwind? Because that's what the Fed's Jay Powell has been worried about, the disorderly aspect of markets, which he views so far as orderly. Is Archegos the sign of perhaps a little more disorder under the surface, John?
Let's turn now to Greg Peters, PGIM Fixed Income Head of Multi-Sector and Strategy, and build on what Lisa's thinking about right now. Greg, any reason to worry about what's taken place in the last week from your perspective?
Not necessarily. I mean, I think the concerns have to be there. I think everyone is worried about financial stability. I think the Fed's definitely concerned about it. The real question is, what do you do about it? And I think the short answer is not a lot. So I think it'll be this constant climb of the wall of worry around financial stability. I'm just unconvinced there's a lot market participants can do. What I do think, though, is that we're in this regime where you'll see a lot more extreme volatility given this low rate environment with this hyper growth backdrop with a very accommodative central bank. So I think this is the world that we live in. Expect more bouts of extreme volatility here because that's the release valve in the marketplace.
Greg, I want to go to a pro question, and this is something we've heard from every single fixed income client, which is bringing in duration. Bringing in or taking out duration is a nonlinear function. At what point in the exercise, the easy exercise of bringing in duration, does it become just harder and harder and harder to do it?
Well, it's been hard for sure, but I think you're getting really close. But, you know, and then you wake up and you see another infrastructure plan on the table. So it's unclear, you know, what that looks like and the size and so on and so forth. But I think, you know, this is a market that has been driven by the narrative more so than the bond math. But you're looking at some of the levels in the bond market from in forward space in terms of curves, and it is increasingly enticing. So I think the move has largely occurred. I just think the narrative will continue to push yields higher and the curve steeper, but I actually think this is creating a tremendous opportunity down the road. I'm not sure it's a crest in the second quarter or third quarter, but I do think you're getting to a place where a bond math will start to assert itself and the narrative is going to take a back seat, but we're not quite there yet.
You're not quite there yet, but are you still buying?
You guys always ask us these questions, and yeah, so I mean, we have pared back our duration. So we had too much duration going into this year. We have pared back substantially, and we moved our position around the curve from out to 30 years into 5 years. But no, this is not an all clear signal by any stretch, because I think the narrative continues to push yields higher. But at the same time, the good news is there's value being created. And I think you're getting closer and closer. And I think many are starting to kind of feel the same way as we do. on that score.
Greg, what a sense from you is as the year grows older, the outlook gets a little bit more interesting. And right now, the outlook is clear. Boom time. Yields are up because the outlook looks so good. Vaccinations are great. We're going to reopen. We're going to look at payrolls growth, maybe north of 1 million for the next several months. Who knows, Greg? But at some point, you factor in the D word, deceleration. What does the rest of the cycle look like? When do you think that pivot point comes, that inflection point, Greg?
Well, I think the important part of the discussion is that it's been pushed out. So initially, our thesis was much more of a sugar high, where you see this tremendous growth, and then you see this kind of reversion to the growth that we observed prior to this crisis. What you're seeing, though, is that the data and forecasts are getting pushed out. And so 2022, our numbers now are 4.5%, which is well above trendline growth.
Yep.
And frankly, we haven't seen 4.5% since the late 90s. So this is a protracted recovery, which is really good news. So I think that kind of pushes out the story. But ultimately, all the debt that we've created does act as a pinch point around future growth. And I think that will start to assert itself. I just think it's going to be delayed versus what we initially thought. But on the inflation side, have a much stronger view, think that will roll over for sure.
A pinch point for growth also for specific companies and their outlooks. And I do wonder, we do like to talk about pendula here on Bloomberg Surveillance. Tom mentions it pretty much every segment. So let's talk about the pendulum of credit versus duration. Is that shifting? For a long time this year, it has been credit. The riskier, the better. That is what is going to outperform. Is that shifting back to duration with credit risk becoming more of a concern?
I'm not sure it's a concern, but if you just look at the numbers in the investment grade corporate market this year, so the total return is down 4.5%, where the excess return, so the spread component, the credit spread component is up, 44 basis points. So basically, the duration move has swamped everything. I think that's the way to think about it going forward. But this time last year, I coined the golden age of credit. I still think we're in that age, but I think it's very compressed relative to my initial thinking. So I think we have time. If you look at what's outperforming in the first quarter, it's been the most COVID-sensitive sectors. I think there's still legs to that. But ultimately, what I worry about around this golden age of credit thesis is that the cycle is much more compressed relative to what we've seen in the past. And ultimately, credit investors have to worry about re-leveraging, which is not the case yet. But it's coming sooner than we anticipated.
A shorter, hotter cycle. That's the view of Morgan Stanley, too. Greg, it's good to catch up. Good to see you. Greg Peters there, PGIM Fixed Income, head of multi-sector and strategy. We need to talk about the banks as well. Over in Europe, Credit Suisse was down yesterday by 13.83% at a close, down another 2.3% again this morning. Tom, for anyone focused on Morgan Stanley, we were down yesterday by a couple of percentage points, not a massive move.
Yeah.
This morning we're positive about 0.7% in early trading.
I went back in my research, John, 2 years, 3 years back maybe, Mark Kitchen writing in Hedge Week, and it was the usual Hedge Week wonderful journalism about the excitement of advancing your prime brokerage platform. And the bottom line is, John, everybody's effervescent up at all times to increase business and to get their fair share of the commission flow. That's what happened here. It's all there is to it. You covered it yesterday with the Goldman move where they had banned this guy and then they brought him back on.
We know what's interesting about Morgan Stanley, though, Tom, and Lisa weigh in on this, is that Morgan Stanley were also offering investment banking services, reportedly, to the cash raise, the capital raise that we got from Viacom last week, which really started this all off in a big way as well. So they were offering investment banking services to help this company do a capital raise, an equity offering, etc. on the one side, and then they were doing prime brokerage with this company, which was heavily levered in a long position in this company as well. And you just saw those two things come together and snap.
You can only imagine what the internal meetings must be like, although perhaps not as contentious as the one in Nomura, where shares fell the most ever yesterday. There's also another question about how the banks work together to unwind these positions more orderly, given the fact that Morgan Stanley and Goldman Sachs went ahead and unwound some of those block trades without the other banks signing off, which was something that has become a point of contention.
Lisa, the reports have been amazing on this.
Amazing.
Tom, Credit Suisse were trying to play happy families. We'll all get together.
Nonsensical.
We'll do something nice.
It's like the three of us.
And then reportedly
When have
Morgan
the three
Stanley.
of us been on the same page?
Who's Goldman around this table?
Never.
Who's Credit Suisse? We're not going to do this.
Really? We're going to do this?
We're not going to do this.
Thank
Coming
God
up,
I have no celery.
James Bevan, CCLA Chief Investment Officer from New York City. This is Bloomberg.
With the First Word News, I'm Ruchika Gupta. Ships are on the move again in the Suez Canal. An almost week-long effort to dislodge a giant container ship stuck in the canal finally succeeded. Authorities expect operations to return to normal within days. Hundreds of ships were forced to wait in line. The Biden administration is sounding sharply divergent notes on the coronavirus pandemic. President Biden celebrated a ramp-up in vaccinations. He said 90% of U.S. adults will be eligible to get a shot by April the 19th. Meanwhile, the head of the CDC pleaded with Americans to wear masks, and she warned of, quote, impending doom as cases and deaths start to rise again. Drivers won't be asked to pay for President Biden's $3 trillion infrastructure plan. Transportation Secretary Pete Buttigieg ruled out plans to increase the federal gas tax or charge drivers a fee based on miles driven. The problem is that the federal fund that pays for roadways and transit system is funded by the gas tax, and that currently runs at a deficit. Shares of the Chinese parent of TikTok trading at a valuation of more than $250 billion in the secondary market. Bloomberg's learned that ByteDance's value has surged in recent weeks. Investors have gained confidence in the business, and ByteDance's founder has weighed options for an IPO. And PayPal has rolled out a cryptocurrency checkout feature in the U.S. starting today. Customers with cryptocurrencies in their PayPal wallets will be able to use them to buy goods from PayPal merchants. Recently, Visa said it would allow the use of the cryptocurrency USD coin to settle transactions on its network. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ruchika Gupta. This is Bloomberg.
generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
The war against COVID-19 is far from won. This is deadly serious. We share the sentiment of Dr. Walensky, the head of the Center for Disease Control and Prevention. The CDC expressed earlier today, this is not a time to lessen our efforts.
Some real cautious words coming out of the CDC in the last 24 hours. That was President Biden referring to them. From New York City this morning, good morning to you all. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Tom, I'll whip through the price action. We look like this. This Tuesday, your equity market is just a little bit softer on the NASDAQ. Your bond market, a whole lot softer. Yields, a whole lot higher. 177 on 10s, very briefly. Right now, where are we? 176.53. Yields are up about 6 basis points. In the equity market, we're down 14. We're off by about a third of 1%, Tom.
Notice gold as well, $16.90, down $24 on gold. That'll bear watching, as well as Bitcoin to the moon, 59,000. John and Lisa have a lot of good questions about the state of Washington. After listening to President Biden there, I have to address with Kevin Cirilli the delicacies of the moment. Kevin, it is ancient history. It is of Garfield of the 19th century, and of course, widely chronicled of President Wilson about 1918 and 1990. These were people who were in office and were ill. Give us a state of the president's health in his day-to-day grind at the White House. He's been doing it for almost 100 days. Great. How's he doing?
Well, look, I think that the White House has said publicly that his health is in good condition and that he is considering to aggressively fulfill and execute his duties. I think, though, that a big test is going to be tomorrow when he is in Pittsburgh, Pennsylvania, and unveils a sweeping economic plan as it relates to infrastructure, taxes, college tuition, and a long-term policy agenda in many ways, for not just for the country, but really for the direction of the Democratic Party.
Kevin, besides holding court at the Hay Adams Hotel and the bar in the basement there pre-pandemic, you are known for understanding the pulse of the White House. Give us your tone on the day-to-day White House that you've observed under President Biden.
Candidly, I think that you have a well-experienced staff, but I also think at the lower staff level, you have this fascinating dynamic in the pandemic era where a variety of staffers are working from home. And that is a stark contrast to the previous administration where most of them were going into the office. So do with that information, interpret that information as you would like based upon your political leanings and your feelings about the CDC guidelines and whatnot. But either way, objectively speaking, working from home in government presents a lot of challenges on the communications front for internal deliberations than it does for Congress, which candidly, Congress has kind of the core staff has been working now for months in the halls of Congress.
Kevin, it's the big reveal tomorrow. Let's just lean on that just a little bit more. What is left that we don't already know?
How they're going to pay for it, and that precisely, I think, is what White House Press Secretary Jen Psaki was alluding to yesterday when she said that President Biden, in his address, would in fact make some announcements for how he does plan to pay for what some are estimating could cost upwards of $3 trillion. In many ways, this almost feels like the release of a budget in the sense that it's always a wish list that the respective office would want to get in terms of if they had their way. But this is a massive undertaking, and whether or not they're able to just push through one giant package, it's looking like they're going to have to chip away at it and take a more piecemeal approach.
Senator Warren went at it with Amazon on social media to close out last week. It was on a Friday in the afternoon, so we all forgot about it coming into this week. But Kevin, there's a real feeling in D.C. that these big tech companies just aren't paying their fair share when it comes to the profits they make in this country and the money they give back to the Treasury. Kevin, what can they do about that?
they can raise the corporate tax rate. And that's something that the Biden administration has been consistent on in terms of where they feel the direction of the corporate tax rate is ultimately going to be headed. I don't see how, based upon the math in the Senate, that they're able to get that through. I also don't see how that would be a long-term sustainable goal, especially when the political tide, so to speak, of midterm elections, of presidential elections in the future continuously point to there being a back and forth in terms of which party has control and power.
And if we're talking about Amazon and we're talking about big tech, yes, there's taxes. There also is the antitrust effort led ostensibly by Lina Khan, who has not yet been confirmed but has been nominated to lead the FTC. What do you think we can expect over the next few months from what some people have called this all-star antitrust team that Joe Biden has assembled?
Well, I think that beyond just the team that he's assembled, there's also some widespread consensus in terms of antitrust. It's on some aspects and elements of this that there's agreement between Republicans and Democrats in some crevices of Congress. But from a broader standpoint, I think that how they're able to regulate big tech is one of the biggest unknowns, and whether or not they're able to do it out of the committee structure or if it's going to take executive order on behalf of President Biden, we'll have to wait and see.
So when we talk about the speech that we're going to be hearing from President Biden tomorrow out of Pittsburgh, how much consensus has there been established among Democrats? In other words, are they coming into this with a bit of a platform that they know they can pass, or are we even more far apart?
I think that this is an opening bid. That's a good point. I think that this is going to be an opening bid tomorrow from President Biden in Pittsburgh. And mind you, President Biden has a long history with Pittsburgh. There's a reason here. Back in 2015, when he was toying with the idea of running for president against then frontrunner Hillary Clinton, he ran in a Labor Day parade with union members to try to drum up support that he would be able to beat Hillary Clinton back in 2015. He decided against running. I bring all that up because this is a manufacturing pitch, it's a working class pitch, and it's the type of coalition that he has been saying that he would be able to put together since as far back as 2015.
Kevin, good to see you. As always, Kevin Cirilli, Chief Washington Correspondent, host of Sound On Bloomberg Radio, weekdays at 5 p.m. Eastern. I want to turn back now to those words of Senator Warren over the past week. Tom, take a listen to this. This was Amazon News. On Twitter, you make the tax laws, Senator Warren, we just follow them. If you don't like the laws you've created, by all means, change them. And this is what Senator Warren had to say in response. I didn't write the loopholes you exploit. Your armies of lawyers and lobbyists did, but you bet I'll fight to make you pay your fair share and fight your union bursting and fight to break up big tech so you're not powerful enough to heckle senators with snotty tweets. Now, a couple of things going on here, Tom. The latter, the snotty tweets, no one should be immune to that. The former, the story around making these companies pay their fair share, that's where the massive policy effort's going to be.
And this goes to the tax legislation. Is it going to be personal or corporate? I don't envision anybody in the moderate Democratic wing that Kevin Cirilli talks about every day talking about individual tax increases. There may be, a token number out there, John, but this is going to be all about business, all about corporations.
Depends what you earn. North of 400K, I think there will be some tax increases on the income side, Lisa.
Yeah, the thing about big tech that I'm struggling with here is how much can the Republicans and the Democrats get on the same page? If they both agree on the antitrust front to some degree, can they both agree on the higher taxes, or is that a no-go for the Republican wing? These are some of the issues that are sure to be debated.
Well, I think for the Republicans, it's pretty straightforward, Tom. It's now the time to hike the corporate tax rate, just as we start a recovery. And a lot of people would just say no.
I think people would look at the action of corporations after the last corporate tax cut, and that's going to be the evidence that they're going to debate in Washington.
Coming up, Vasilios Giannakis, the Bank Lombard ODA head of FX strategy from New York City this morning. Futures down 13. We're off by 1/3 of 1%. On radio, on TV, this is Bloomberg Surveillance.
80% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio. And here is your price action. Equity futures down 1/3% on the S&P. It's about relative performance. It's been the story since the beginning of November, and it's the story this morning as well. Relatively speaking, outperforming the Russell, down by 0.2%, underperforming the Nasdaq, off by 0.6%. All begins and ends with the bond market. You know the story in line with all of this. Correlation or causation? We can do that again later for the 20th time in the last couple of weeks. Yields up 5 basis points on a 10-year to 175.81, 177 early this morning. We take out the post-pandemic highs of 2 Thursdays ago, intraday, 175.81 right now. Yields up on a 30-year by 3 basis points to 243.52. But let's finish here, Tom. The bond market elsewhere, in Germany, in the UK, at the start of January of this year, we had a yield on a UK 10-year, the low of the year so far, 17 basis points. Gilts right now, 85 basis points and up another 6 basis points on a session. And what's interesting about this morning is the move isn't just treasuries. Once again, it's global. It's the UK and it's Germany too. So Bunds now just negative 27 basis points and off by about 5 basis points on the day. And Tom, we know this story. Undue tightening. And we also know the ECB has said they are committed to actually front-loading some of that bond buying in the coming quarter. When does that big effort actually begin?
And John, that's a financial aspect here, but I would go back to the pandemic, which I think dominates what we're talking about for global Wall Street. This is a Europe flat on its back with failure of pandemic, and they got to get their act together, period.
Bottom line, Tom, and what we're seeing in the United States is a lift in yields that is consistent with a brighter outlook. You don't see that in Germany. You do see that in the UK. This is the broader macro story. Without a doubt, the dominant story of the last 24 hours is about the blow-up of a big fund. Can we call it a hedge fund, a family office with more? Here's Romain Bostic.
Yeah, it could be pretty much whatever you want it to be given its size. Of course, the fallout still continues. A lot of people still trying to figure out who's going to be left holding the bag. You are starting to see some of those dip buyers come back into the market and say, okay, maybe the dust has settled enough to now come back in. You take a look at Viacom, CBS, not only getting bids here in the pre-market, you've actually gotten a couple upgrades on the stock, primarily based on the valuation, and more importantly, that valuation drop, making it a little bit more attractive than where it was the prior day here. VIP Shop also got caught up in this. That's getting a bid not only because of folks coming back in because of valuation, but that company also announcing a stock buyback, so taking advantage of that drop in price here to give a little bit of a boost here, going higher here, and the banks getting a modest rebound here, though, of course, Morgan Stanley, one of the banks most hit hard, at least on the U.S. side yesterday, down about 2.6%. You flip up the board and look at some of the more individual stories that have nothing to do with what's going on with Archegos.
Interesting.
You take a look at GameStop here. I know this is a fan favorite of yours, Tom.
Thank you.
Yeah, well, look, I mean, they finally got a few new executives here. They're bringing over Elliot Wilkie over from Amazon Fresh. He's going to be joining here as basically their chief kind of brand officer here. They also promoted 2 other folks who are already within the company here, and they were tied to Chewy. But prior to this, they're basically coming in merchandising and brand roles as well. So if there is a fundamental story to all that GameStop saga, the sort of the pre-Archegos saga here, then here it is. They're getting a little bit of a boost. And PayPal, Tom, pay attention to that as well. PayPal now going to begin accepting cryptocurrency for a lot of payments beginning this very day.
Oh, very good. Romain Bostic, thank you so much. Greatly appreciate that. To close this afternoon, maybe we'll have more information on this banking story, this margin call story. Before I bring in Vasilios Giannakis, I'm going to editorialize here, and I think it is so important. What has changed from Wall Street from 1998 and LTCM out to where we are now? It is the corporatization, the public stock structure of our banks. Bank Lombard Odier, led by Patrick Odier and the family back to 1796, is a completely different story. Imagine if we had the partnership structure of Bank Lombard Odier, would we have this prime brokerage mess that we're in right now? We digress now to foreign exchange, and Vasilios Giannakis does not want to talk about prime brokerage, and we're thrilled he could join us today. Vasilios, the world has changed. Everybody was weak dollar. Are we resilient dollar, or do you adjust to a new strong dollar?
Well, it's a tough call. I mean, all of us, including us, we definitely got it right, at least so far in 2021. Look, I think we have a couple of things going on here. First of all, we have the global recovery, and the global recovery, you see a synchronized increase in yields, and you see a weaker dollar, and this is what we've expected. But what we have right now is an unsynchronized recovery as far as the pandemic is concerned. So right now you have in the US about 40-45% of people inoculated, pretty much the same in the UK, but the European Union is lagging significantly behind with just 15%. So I think there is an element there that growth recovery is going to become less synchronized than initially was expected, and that is actually what's giving the boost to the dollar. That is why you've seen US to German bonds yield differentials widening. So yes, the dollar has been resilient. It has risen by approximately 3% on a trade-weighted basis. I still think we are relatively early in the global recovery. I think it's going to be quite a sharp recovery. And I think once we get that vaccination gaining traction out there, I think we're going to find ourselves in, again, a moderately lower dollar environment.
Well, let's talk about the moves we've seen. Dollar China, 657. Dollar yen right now, 110. Euro dollar breaking down to 117. Are you willing to fade one of those pairs and some of those moves right now?
Well, dollar China, I think, 655 to 660 is likely to be the top. I think it looks a bit toppish, and I say this largely because the Chinese economy has weathered the pandemic very, very effectively. We've seen some very, very tentative evidence of a marginal slowdown, but nonetheless, the momentum is there. So we are going to see flows into China, and I still remain a renminbi bull in that respect. Euro dollar, I think 116, 117 is going to represent a strong support level. I don't think we're going to break it unless something goes terribly wrong, whether the pandemic or another black swan. So, at these levels at 117 and monitoring the development of the vaccination in Europe, I would be tempted to return long euro dollar here. Dollar yen, it has been quite disappointing for us and for a number of people. I think above 110, I'm inclined to throw the towel a bit. I think it can go a bit higher, but with yields right now 175. Will we see a very, very robust and sustainable retracement below 105 towards 100? I think it's going to be quite difficult.
And Lisa, just looking at these moves right now, $6.57 China, Euro dollar 117. Vasilios just leaning, pushing back against some of this recent dollar strength.
And a lot of people are saying that, and this certainly coheres with what they were saying heading into 2021, that the dollar would actually weaken, especially as we eventually got a synchronized global growth picture, although we are not getting it yet, which really raises a question of whether we've beaten out some of those dollar shorts sufficiently, Vasilios, in order to get to a place where you're not worried about leveraged carry trades unwinding, where you're not worried about further people being called out short and having to unwind and causing further strength in the dollar.
Well, not right now. That was definitely the issue a couple of months ago. But right now, at least what we can see from publicly available data, we are no longer in an environment where we are significantly short. As a matter of fact, CFTC data shows that the speculative community has actually returned long, marginally long dollars. So I'm not that much worried about the positioning. I think the short squeeze has actually materialized, has taken place. It has strengthened the dollar, but I don't think that it's going to have any meaningful, any noticeable impact going forward. I think right now it's going to be a tug of war between momentum and what is happening on the underlying fundamentals, how quickly a large number of developed economies are going to get their populations inoculated so that they can reduce the risk of further lockdowns and economic impact, basically.
Vasilios, always good to catch up, sir. It's good to see you. Vasilios Giannakis there, Bank Lombard, ODA head of FX strategy. And just to borrow some of the words there, Vasilios, and I think they're important, Tom, what we've seen is a synchronized global growth call. But what we've actually seen is something very unsynchronized, very unsynchronized. And that's what you've got to grapple with, together with a synchronized lift in yields against, inconsistent with, an unsynchronized global growth story.
In stealing from Michael Rosenberg, I mean, John, it's real simple. It's about flows and relative interest rates. I would guess now relative interest rates are predominant with the United States, 10-year yield 1.76%. But, you know, to me, it's a humility, John. We're in March. We're almost into April. And you go back and you look at where we were 12/31 with the year forward reviews. It's a little bit different right now than we thought.
Also purely growth differentials too, just away from the complexities of rate differentials and flows. Just look at the basics, growth differentials. And to hear from Greg Peters of PGIM at the top of this hour say that it's no longer just about a big burst in 21, we're thinking more about that continuing in 22, that's more new, that's fresh. That's the last couple of months, Lisa, where people are having that conversation a little bit more. And I think that started with Ellen Zentner and Morgan Stanley on the south side, really pushing out that growth story to next year too.
But don't you think there's a partition now of Morgan Stanley saying, yeah, bigger boom and then drop off versus what Peters is talking about, which is a more extended boom? I don't have an answer on that, but that's a mystery.
I think originally it was a lift to the forecast in 21 and 22, and Morgan Stanley refined that and are talking about a cycle that is shorter and is hotter, Lisa. But overwhelmingly, I think the consensus right now is starting to shift up their view for 22 as well.
And I'm waiting to see when people start talking about, to use your phrase, the D word, deceleration, and what that means for some of the over-leveraged companies and over-leveraged economies and how much that becomes the focus. I mean, right now, we talk about the dollar strengthening. I keep wondering what this means for emerging markets, the idea that yields go higher in the U.S. in this non-synchronized recovery. How do we get emerging markets to recover financially if they have all this additional debt and it's harder for them to pay it back?
There is a hope we just get this rolling reopening. That's the hope, right? This sort of sequential rolling reopening.
The hope trade.
Around the global economy as the year grows older. Coming up in the next hour, Representative Gregory Meeks, the Democrat from New York and chair of the House Foreign Affairs Committee. Looking forward to that conversation. From New York this morning, good morning to you all. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your equity market's down 15 points on the S&P 500. We're negative 0.4%. Your headlines in the bond market, 10s, 177. Very briefly, right now, 175. Call it 176. Yields up 5 basis points. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. President Biden is planning to take on the nation's challenge of inequality with a mass expansion of government spending. The president also plans a revamp of the tax code. He'll start to outline his plans tomorrow in a speech in Pittsburgh. The president's remarks will lay out the infrastructure part of the $3 trillion spending package. Social spending programs will be unveiled next month. The immediate crisis of the Suez Canal blockage has ended, but the battle over damages is just beginning. It's estimated that the cost of the canal's closure was $10 billion a day. Cargoes were delayed for days, if not months, and that's likely to lead to a flood of claims by everyone affected, from the shipping lines to manufacturers and oil producers. BioNTech has now raised the number of coronavirus vaccine doses it plans to make this year by 25%. The new target, 2.5 billion doses. BioNTech and Pfizer collaborated to develop the vaccine. BioNTech estimates that in the fourth quarter, it took in $405 million in revenue versus $33 million a year ago. Toyota has shrugged off a semiconductor shortage that has hurt output at some of its rivals. The world's top-selling automaker says production rose 4.6% in February from a year earlier. Toyota is less exposed to the chip shortage because it keeps a strong stock of key components, including semiconductors. And the U.S. is abandoning its 4-year-long antitrust battle against Qualcomm. Prosecutors had accused the company of abusing its dominant position in chips that power smartphones. The FTC says it will not seek a Supreme Court review of an appeals court decision that found Qualcomm's practices weren't anti-competitive. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy, and we need companies to step up.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
I think we are seeing a bit more in terms of drips and drabs, but I think the main bulk of it has been digested. We're just not seeing the kind of crazy activity that we saw on Friday. As far as we can tell, those seem to have abated for now, but it's way too early to give a full all clear.
Steve Soshnick there, the Interactive Brokers Chief Strategist from New York City this morning. Good morning. Alongside Tom Keane, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Tuesday. Equities a little bit lower. A mild move on the S&P 500, down 0.4% and negative 14 points. Yields higher. We had a little look north of 177 on 10s earlier in the session. 175.45 right now, up 5 basis points. We could talk about the euro dollar clinging to 117 at 117.32. But Tom, let's just touch on dollar lira just quickly. We roll over just a little bit. Still lira weakness, but that currency pair now up just 1.7%. Governor Cafciolu speaking at the moment. The CPI outlook requires a tight monetary stance, i.e. the policy rate has to be above the inflation rate. So, Tom, so far, if the governor was sacked to be replaced by a governor who might not do what this market wanted it to do, at the moment at least, and I stress at the moment at least, he's saying maybe what some people in this market want to hear.
Yeah, well, it's a market that's churning. There's no question about it. We're a little red here, a little bit weaker in the last number of minutes. But I really want to look at the correlation. We're going to address that right now and into the beginning of the 8 o'clock Wall Street time hour. Gina Martin Adams joins us now. We say good morning on Bloomberg Radio and Bloomberg Television to her with Bloomberg Intelligence. Gina, you have been absolutely dead on of corporations framing up for a boom economy. We have a problem. You and I have never seen a boom economy like this, and none of the corporate leaders have ever seen a boom economy like this. How do we know how to guesstimate Q2, Q3, and Q4 in the equity world?
Well, I think you've hit it spot on, Tom. I mean, frankly, the analyst community has been behind this recovery since the second quarter of last year. And at least as far as the economic indicators would suggest, they're remaining behind the recovery. I mean, just a couple of stats. Retail sales are 8% above their former peak levels. Orders, industrial orders, excluding aircraft and parts, nearly double digits above their former peak levels. Yet analysts are saying S&P 500 revenue is just barely going to match former peak levels over the course of 2021. So there's still a lot of catch-up going on. You're right. We haven't seen something like 7, maybe even close to 10% growth is what we're going to get in 2021 in terms of real GDP growth. We haven't seen that kind of recovery. We also, though, hadn't seen the type of recession that we had in 2020. And I think that this is important to consider is that sort of immediate shutdown of the economy hadn't happened before. It's very mechanically driven, completely unnatural as far as recessions go. So now the recovery is somewhat unnatural as well. And I think we're going to continue to follow the pace of economic indicators very closely. But frankly, we are somewhat data dependent as we navigate our way through what is going to be a very unusual economic recovery in the United States.
Gina, what's the most important data? Because we talk about inflation and the tie into yields, and then we also talk about just the root profits of some of these companies. What are you looking at?
Yeah, so we actually run a fair value model for the S&P 500, and it's a very narrow list, actually, of factors that really matter for driving earnings as well as valuations. Clearly, on the valuation side of the equation, multiples are very closely related to what happens with interest rates, but also corporate credit spreads and inflation. We want to watch inflation because it does feed into what's going to happen with yields. Right now, rising inflation pressures are actually a very good thing for stocks. Stocks and bond yields are positively correlated. They've been positively correlated for the better part of 20 years. When they go negatively correlated is the problem. We're not in that situation yet, but we want to watch for it. As interest rates rise, they're likely pricing in a rise in inflation expectations. As long as that rise in inflation expectations doesn't get too hot, we're talking PPIs in the 4 to 5% range. That's too hot. But right now, PPIs are just moving higher. That's consistent with expanding margin growth. And then on the earnings side of the equation, you also, when you think about revenue growth, you want to look at things like retail sales, orders growth, the falling unemployment rate, commodity prices, which are up at a double-digit pace. Those are the main factors that drive earnings growth. And our model suggests we should get nearly 30% earnings growth in 2021. In a bull case, we can get to 35% earnings growth, which would be extraordinary earnings growth and certainly not in the analyst consensus expectation.
Does that earnings growth matter if we get Treasury yields, 10-year Treasury yields above 2%?
Absolutely. It's essential, frankly. If you have earnings growth that accelerates faster as Treasury yields are rising, it would imply a much more constructive environment for equities. Your problem is going to be if Treasury yields are rising and earnings growth starts to slow. And I think you alluded to this in your commentary earlier this morning, talking about when are we going to talk about the deceleration? Because if you get to a point in time where yields are still rising, we're still contending with some degree of inflation pressure, and yet potentially demand or top line growth starts to decelerate, that's a point of friction for the equity market we want to watch for very carefully. That's not the situation we're in yet. I don't think that's a situation we're going to be into until at least the second half of the year, maybe 2022. But it certainly is what we need to watch for as the next phase for the equity market, which is a very different type of trading environment than the one we're in today.
Well said, Gina. As always, Gina Martin-Adams there of Bloomberg Intelligence. Thank you. That's the story of the moment. Let's talk about a story of the last 24 hours as well. In your equity market, a lot of attention paid to the banks. Morgan Stanley down by about 0.2% of the pre-market. Credit Suisse is down by about 2 percentage points after a 13.83% move lower yesterday, Tom. We trim another couple of percentage points off Credit Suisse in Zurich trading.
And bounce off the pandemic, it did not get back to February levels, but obviously it's reversed halfway back down. John, what's amazing here, and Eliza Martinuzzi publishing moments ago, she is exquisite on EU banking, and particularly the Swiss view, and there the compare-contrast is UBS versus Credit Suisse. It is stunning, the differential. Not enough is made about this. On the Bloomberg, apples to apples, UBS is 0.93 price to book, and Credit Suisse just isn't there, 0.59. There's not enough discussion. Everybody talks, John, about Deutsche Bank and their travails. Eliza's dead on. Credit Suisse is a train wreck.
Well, let's talk about Credit Suisse now just a little bit more, Tom. In Elisa's piece this morning, I think what she gets at the heart of is something further down the page. When you get to Tidjane Thiam, the former CEO, who had a stated goal of de-risking this bank, and here we are waking up in the last couple of weeks, the Credit Suisse at the epicenter of the saga around Lex Greensill and the blow up there, and then once again at the epicenter around Archegos. And I think Elisa getting to the point and asking the question, is this coincidence? Some would think not.
And it's a partition here, folks, away from the people we talk to at these banks who are in research and economics versus, John, the fancy people in Credit Suisse just time after time after time seems to struggle with this. They have new management.
Lisa, the lure of making money, too much for some.
The lure of making money at a very, very low interest rate time. I mean, there's sort of a curse on both sides here. Do you take risk, especially if your interest-bearing business just isn't providing the income at a time when shareholders are expecting a lot more? And Credit Suisse, perhaps on the wrong end of that bet.
Or is it just a one-way market where you're seeing your peers make a load of money, Lisa, and you need to get on board?
Well, until you don't, right? I mean, this is the question with Nomura as well.
We'll ask that to James Bevan, CCLA Chief Investment Officer. Does he like what he sees on Wall Street over the last couple of weeks? From New York City this morning, good morning. Alongside Lisa Abramowitz, Tom Keene, I'm Jonathan Ferro. In your equity market, we declined on the S&P. We're down 1/3%. Yields are higher by, let's call it 5 basis points to 175.63. On TV, on radio, this is Bloomberg Surveillance.
This patch of land in northwest Saudi Arabia is going to become Neom, a city powered entirely by renewable energy. The government hopes the site, which is the size of Belgium, will be a clean energy hub, not only for the kingdom, but also the world.
This here is at the borderline between Mission Impossible and Suicide Mission. Lucky enough, so far we've just been on the right side of the line, yeah. But you know, it's very close to that. You know, this is just smoking. This is nothing ever I've seen or heard of the dimension, the challenge. You know, I'm not talking energy only. You know, but in its broadest context, including the geopolitical dimension, including the cultural dimension.
NEOM will include a $5 billion hydrogen plant run on wind and solar energy. All of the zero carbon fuel it produces will be shipped to international buyers in the form of ammonia. When it starts operating in 4 years' time, it will be one of the biggest hydrogen facilities in the world.
Can't explain NEOM on the back of a set of PowerPoints and a video clip. You just need to be here. You need to breathe it. And specifically the startup mode and things happening. Buses all around you here.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think we're about 4 to 6 weeks away from just this economy just completely reopening and taking off.
The vaccine alone and the COVID story alone does not tell the whole story.
This is going to build to a lot of momentum as this year goes on. So I think the environment is going to heat up a lot.
There are going to be parts of this economy, companies that they're going to see demand they've not seen in decades.
Expect more bouts of extreme volatility here because that's the release valve in the marketplace.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television. Nothing going on. John, Bitcoin, 59,000. Move along. Nothing to see here. But there is to see, John. I don't get the correlation. Everything else in this market, John, is correlated this morning.
That's the whole point, isn't it? An uncorrelated move in Bitcoin, and that's what the Bitcoin bulls want to see a little bit more of. The quest to make it digital gold. We can touch on that a little bit later this morning if you want, Tom. Elsewhere, it's equities down, yields up.
Yields
got a bit
up.
of story, right? Down a third of 1%, yields up 5 basis points on 10s to about 176.
Well, the yield and the 10-year yield through to new highs, recent new highs. We don't see that yet in the real yield, John, and I see it correlated in nicely to, red on the screen right now, futures negative 13. But these are markets just waiting for the president's speech and waiting for that jobs report on Friday.
But look at the rest of the world. Yields are up in the rest of the world too, in the UK, in Germany. Is that consistent with the outlook in Europe? It's not consistent. It's inconsistent with the outlook in Europe, but it's being driven by treasuries. Treasuries are at the epicenter of this. And the policy decisions of Washington, D.C. are very much driving it too.
And I go credit first, as Doug Cass mentioned yesterday, credit first after equities. We'll talk to James Bevan in a moment. Lisa, what's so important to me is just simply the calendar. March ends in with a lion, whatever that phrase is, and April is here, and it's a boom economy April.
Yeah, it's a boom economy as we head into a possible end of the pandemic. I want to tie Bitcoin together with higher yields and the story of the day, which is a a more optimistic future. This is important, and this is what Troy Gajewski was saying last week of Skybridge, that Bitcoin is one of the major macro bets on basically the largest economy in the world printing money and debasing its currency. That is the bet that it is, so that's why it makes sense for Bitcoin to rise in tandem with rising yields and expectations of more spending for the United States, Tom.
John, what I see in the bank uproar, the margin call uproar, is what we don't know. There's a lot of news flow today, but John, what don't we know right now?
We still don't know what the banks knew, and whether the banks knew about the positions elsewhere, whether the prime brokers, and that's what we need to get our hands around, Tom, because it leads to one tricky question either way for these banks. If they knew a lot, then what on earth were they doing? And if they didn't know, why didn't they know? And if the SEC gets on the phone, and we understand the SEC is already quizzing some of these names, Tom, that'll be the questions they're asking. What did you know? Okay, why didn't you know? And if you did know, what on earth were you doing?
Lots of different essays on this. Martin Uzi of Bloomberg just publishing, Wigglesworth over at the FT publishing as well. And the basic theme here is we've seen it before, but John, it does seem to be contained.
Contained so far, but what's curious about this, Tom, and we keep coming back to this point, I do think it's important, this happened in a pretty normal market. No sign of stress, no abnormal events took place, and yet something broke. And that tells you a lot about how loaded things were to the one side of the boat. And that's just natural of any bull market. The leverage starts to pick up. Yes. And for anyone tying it back to interest rates, I think you've got to remember that one of the biggest bubbles that we ever blew up in global markets took place about 15 years ago and happened in a rising interest rate environment. It's the one-sided move that leads to the additional leverage, and it's the one-sided move that often leads to a fragile market, and it didn't take much to break this fund.
In normalizing real yields, we're not back there on the 10-year yield, a negative, where am I here? I've lost on the Bloomberg, a negative 0.6. Thanks, Lisa, 0.6093.
Do you like how Lisa just got that in her head?
Didn't
even
check.
I mean, Tom, 0.6.
She's got a Bloomberg.
Carry on.
It's like in the Queen's Gambit. It's like in the Queen's Gambit, John. She has a Bloomberg terminal screen on the ceiling of her bedroom, and she's watching 24/7.
Yeah, my kids love it, I will say.
I bet.
Yes.
Do you want to touch on some price action quickly?
Give us some price action to save us here.
I'll do that. There you go. Equity futures down 14 on the S&P 500 with negative a third of 1%. Yields, Tom, coming up about 5 basis points. Life above 177 was short. It took place a little bit earlier on, but that's the trend this morning. Yields are higher, equities are lower, the dollar stronger, euro dollar 117.40.
Yeah, there's the data this morning, and we're watching it with economic data coming in. I'm watching that 650,000 statistic on payrolls. Okay, here's what we're going to do, folks, and this is important for Global Wall Street and everybody else on radio and TV. Why don't we find someone out there totally removed from the madness of margin calls and excess leverage? James Bevan would be a candidate with CCLA, Chief Investment Officer. He has been running sober money for decades, and he joins us today. James, I'm not going to waste your time with the margin call discussion and that. What I am going to say to you is, how do you operate in this milieu? What do you actually do when you've got big banks bouncing off of big losses?
What I observe, Tom, is that we are indeed going to get excellent economic growth figures for April and May, significantly on the back of the actions of the Biden administration, and not least the $1,400 posted out to the eligible persons. And I think that, therefore, we will see something in the order of $180 of earnings to the S&P 500 in the current calendar year, rising to $200 next year. Now, of course, baked into the cake of those numbers is a premise that companies are going to invest in capital that improves productivity and allows margins to stay elevated. And given the environment that one might observe for inflation and money rates, I think that justifies a year-end target for the S&P 500 this year of 4,300 points, rising to 4,800 points next year. And if there is a real risk, I think it is twofold. One, that the Federal Reserve continues to argue that it doesn't need to change rates, but the bond market therefore does the work for quelling inflation. That leads to a dislocation between bond yields and equity prices, and inevitably leads to a correction. The other risk, which I think is just as real, is that a large chunk of the $1,400 that has been posted out is applied to the equity markets. We get a melt up during May and early June, and that's the point where we should take money off the table.
James, optimal reopening play then, what is it?
For me, it's the world-class banks that operate in the United States, so JP Morgan and Bank of America. seems to me that they have ample opportunity to lend sensibly into an accelerating market. They have excellent loan criteria. I don't think they're going to trip up, but they will be significant participants in economic recovery. The other big trade, I think, is shifting from consumer staples to consumer discretionary, which is a very obvious trade. But I'm surprised when I look at the portfolios of fund managers in the marketplace. How few have yet to really make that switch?
I gotta say, it does sound like there's some subtext there when you say you're favoring banks that lend sensibly, and then you talk about JP Morgan and Bank of America, two of the banks that were somewhat immune from the recent blow-up of Archegos. Are you staying away from other banks, from perhaps European banks or Japanese banks that got embroiled in this issue? Or do you see them also as potentially holding value as the yield curve steepens?
No, I am absolutely staying out of those areas. I worry that the European banks face a perfect storm of continuing negative rates. And after all, when one thinks about how the European Central Bank's Target 2 system operates, unlike the Federal Reserve arrangements in the States, where the regional central banks to zero their interbank balances, there are huge imbalances within the Euro system. Germany has to lend huge sums into the Target 2 system. The Bundesbank then calls the commercial banks to provide capital, and having asked for the capital, then sends them a bill because of negative interest rates. No surprise, the European banks are in real trouble. And I would observe that the French banks have been pulling back in lending into Asia. That strikes me as a real sign that French banks are going to be in relative trouble. If you wanted to look outside the States, I think the most interesting area is India, where I see an accelerating economy. I see a reasonably well-run banking system. Names like HDFC, I think, absolutely stand out for consideration.
James, I'm going to jump in just to bring some breaking news just quickly. Germany to reassess the AstraZeneca vaccine after more thrombosis cases. Tom, this just speaks to the divide between the United States and Europe right now. Just a compare and contrast of the last 24 hours. President Biden talking about making the vaccine eligible for all adults in America, 90% of adults by the middle of next month. And here's Europe grappling still with the AstraZeneca vaccine to reassess the AstraZeneca vaccine in Germany after more thrombosis cases. That headline just crossed into Bloomberg.
Canada yesterday with much the same treatment. I'm not saying equivalent treatment, but certainly, John, it's a trend.
James, how on earth do you stay long Europe in any way, shape or form with this going on in the background?
I think it's extremely difficult to be positive about the outlook for the European economy. Fiscal policy is a mess. I think that there are real tensions within the Euro system. If you asked me to talk about a country that is worth considering, it would be Italy. Because I do observe that there are political shifts in Italy which will be positive for the long term. Equally, when I think about the sorts of European companies that I would favour, it is the giants that are capable of making money like LVMH, which I think remain extremely well run and clearly should be, from my perspective, long-term core holdings of a growth-focused portfolio.
James, thank you, as always. Let's get back to that news. James Bevan there, of CCLA, Chief Investment Officer. Lisa, always important not to just sort of offer my opinion on any of this and just go to the data. And the data in the Bloomberg tracker right now, Germany is given about 13 million doses. So that's enough for about 7.8% of the population coverage. Just compare and contrast that to the effort in America right now. 146 million doses, 22.4% population coverage off the back of those 146 million doses. And that headline, Germany to reassess the AstraZeneca vaccine after more thrombosis cases, it's hardly going to encourage the take-up of this vaccine in many countries across Europe.
That's where I was going to go. The messaging of this has been so confusing. What are they trying to accomplish? I mean, yes, you have to obviously follow the science, but why is it that science officials, health officials that come on this show say that those fears have been overblown, and the U.S. coming out and saying that the AstraZeneca vaccine is safe, really raising questions, especially after Angela Merkel did a 180, saying that they were going to shut down for the Easter break and then saying, just kidding, I was wrong?
It's not for any of us to comment on the science behind some of the decisions or the commentary, Tom, but we can talk about the consequences, because the consequences are clear. There is a huge PR issue around this vaccine now in Europe, a massive issue that seems only to be getting worse and not better.
Yeah, I'll go with that. And you wonder who comes to the rescue. I mean, if this is not going to work, they've got to find another solution. Maybe it's Pfizer, Moderna, and the others, J&J.
Yeah. Coming up, Congressman Gregory Meeks, the Democrat from New York and chair of the House Foreign Affairs Committee from New York City. This is Bloomberg.
With the first word news, I'm Rishka Gupta. Ships are on the move again in the Suez Canal. An almost week-long effort to dislodge a giant container ship stuck in the canal finally succeeded. Authorities expect operations to return to normal within days. Hundreds of ships were forced to wait in line. OPEC expects the global oil stockpile surplus that built up during the pandemic to be mostly gone in the next 3 months. That's earlier than previously forecast. The cartel says the precise turning point will come in July. Those estimates assume the OPEC Plus alliance increases production in May. The group's expected to maintain current limits for another month when it meets on Thursday. Drivers won't be asked to pay for President Biden's $3 trillion infrastructure plan. Transportation Secretary Pete Buttigieg ruled out plans to increase the federal gas tax or charge drivers a fee based on miles driven. The problem is that the federal fund that pays for roadways and transit system is funded by the gas tax, and that currently runs at a deficit. Shares of the Chinese parent of TikTok are trading at a valuation of more than $250 billion in the secondary market. Bloomberg's learned that ByteDance's value has surged in recent weeks. Investors have gained confidence in the business, and ByteDance's founder has weighed options for an IPO. And PayPal has rolled out a cryptocurrency checkout feature in the US starting today. Customers with cryptocurrencies in their PayPal wallets will be able to use them to buy goods from PayPal merchants. Recently, Visa said it would allow the use of the cryptocurrency USD coin to settle transactions on its networks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
What hasn't been remarked about as much is how much positions below the surface are being whipsawed. These daily rotations where you see sectors and styles moving 2-3 standard deviations in a day because investors flip back and forth between reopening trades and stay-at-home trades, that is also causing a lot of pain if you're on the wrong side of those moves.
I think it's fair to say a less constructive tone coming out of BlackRock in the last 24 hours. Rick Reader yesterday, this morning, Russ Kostrick, the BlackRock Global Allocation Fund portfolio manager. From New York City this morning, alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Counting it down to the opening bell, about 1 hour and 12 minutes away, and here's the price action. Equities down, yields higher has been the story throughout the session this morning. We're down 10 on the S&P, a negative 0.25%. We're declining on the Nasdaq too, with yields higher by 4 basis points. Off session highs, we did have a look north of 177, now 175.10. And outside of that, Tom, I'll keep it brief. Dollar strength, dollar index 93 handle, euro dollar 117.42.
Correlated and changed 1.75 in the 10-year yield. I would note a little weight in equities, but all in all, a resilient tape into 3 important days for the American labor economy. Right now, Gregory Meeks joins us. He is a Democrat. He is from New York. This could be a 2-hour conversation because of his perspective on foreign affairs and his perspective as a congressman from John Fitzgerald Kennedy Airport in New York, the 5th District in New York, and we welcome the congressman back again. Congressman Meeks, on infrastructure, I got good news. New Jersey's worse than New York. That's all we need to know. New York is doing fine right now by any civil engineering study. But you know, when you get off the plane in New York, at LaGuardia, at JFK, anywhere else, there's a lot of roads that are troubled, a lot of bridges troubled. Some 400 bridges in New York State are 100 years old or more. How do we fix this with this new infrastructure bill? What's different this time right now?
I think that this time we're going to get something done. I think that if you talk to Democrats and Republicans, I believe, they understand that if you look at our crumbling infrastructure, like you said, not only in the city of New York, but across this nation, that we've got to invest in it. It's just the same as, those of us who, fortunate enough to own homes. You've got to invest in your home to keep it up. Otherwise, it will crumble down no matter how well it was built. But if it was built 50, 60 years ago, like our infrastructure, it deteriorates. And therefore, you got to invest in it. And if you invest in it, then that makes it profitable for everybody that will utilize it, because everyone will utilize that infrastructure.
Can we do this with bond financing of the maturity and length of our new bridges, our new roads, and indeed a new terminal at JFK? Why can't we just finance this out 30, 40, 50, even dare I say 70 years?
Well, I think that what we need to do it is a combination of all. It's going to take a little bit of everything from everybody. That's why I'm a firm believer in these a number of public-private partnerships. So as I look at, for example, what we're doing at JFK Airport, there needs to be some government investment in it, and we're fighting to get that. I tried to get some of it in because as a result of the pandemic, of course, you look at the revenue that was at the Kennedy Airport, it went down tremendously. So government should help in it. But also, we've had private industry that's investing in it. So we need some sacrifice from them. And that's why we extended the lease on the airport so that there's a longer term for them to get a return on their investment for the money that they will be putting into it also. So you're getting money from both sides in that regard, which is fair to the taxpayers and it's fair to the private investors also.
Congressman, you wear many hats, and I want to turn to a delicate question about foreign policy, if I may. Companies are getting very much entangled with what is happening in China very much around the Collins situation in Xinjiang. And I wonder from your perspective whether you think that US-based companies should face a ban of using cotton out of Xinjiang.
Well, here's what I think, and I think that what we should do, and this, I believe this on foreign affairs, is to work in multilateral ways. So I was a strong supporter for example, and here's where I think that we made a mistake. I was a strong supporter in TPP, working with other countries to make sure that the rules were level and to, instead of isolating ourselves, make sure that we all are playing by them. If China doesn't play by those same rules, then China would be isolated. And so when they are playing with certain products, particularly when you talk about the type of product that you just mentioned, and chips, etc., that it is us who believe in, I'm a firm believer in the WTO and others, and we need to enforce those laws and rules, and it's China who's violating them. And so as opposed to just the United States by ourselves, we're not as effective. But if it's the United States and our friends in the EU and our other doing it collectively, now you're having something that is really going to have effect on China.
But Congressman, right now already, and forgive me for jumping in if I may, US-based companies are already facing potentially a boycott in the mainland right now. That will hurt their revenues, their profits, and to get in line with the policy of the United States, you need to get these multinationals on board, and we've seen that repeatedly not work out. We saw it with the Walt Disney Company last year in the production of Mulan, and we're seeing it with Nike right now, who are trying to avoid using cotton from Xinjiang, along with other multinationals too, and they face a boycott on the mainland. How do you offer them cover to make the decision that would be in line with your administration?
Well, the way that you offer them cover is that if they work collectively together, we can reverse it. And we can reverse, I know that China is doing what it's doing because they think that they would put pressure on us in that regards and isolate us. So the way that you change that is working with the multinationals collectively, putting them all together, figuring out how we can work together so that their issues and their concerns are resolved, and then putting that proposition versus China.
But they want to be there, sir. That's ultimately the problem. They want to be there. They want to straddle that fine line between pleasing you and a progressive consumer base in the United States, and they want a presence in China at the same time. So I have to go back to the previous question. Is it something you would consider, banning these companies and making the decision for them, banning them from using cotton from that region?
See, I don't like to use the word banning. I like to use the word working collectively together. And that means that you can come to a resolution collectively, understanding they all have the same business interests. I don't want them to damage their business interests that they have in China. I want China to be able to, one of the things is to open up their markets in regards to our companies so that we can compete globally, just as China competes, and we have an open economy here in the United States. And that's equitable. And that's what trading is all about. That's how you work with both multinational corporations. So, in my estimation, what we want to do is talk to our multinationals and let them know that it is important for them to work collectively together in the long haul. It benefits all of us in the long run if we work in that spirit, in that cooperation.
Congressman, it's a really delicate issue right now, and I appreciate your input on the subject. I'd love to catch up with you again soon on it too. Congressman, thank you. Congressman Gregory Meeks there, the Democrat from New York. And Lisa, on infrastructure and a very delicate foreign policy issue right now too.
Yeah, trying to toggle between maintaining a good relationship with China, supporting your own companies, and also getting allies on board, John.
A really difficult trilemma. Coming up on the outlook for this economy, Ethan Harris of Bank of America from New York. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City for our audience worldwide, this is Bloomberg Surveillance Live on TV and radio. I'll keep this short. This is what the situation looked like in the bond market. Yields are up by 3 basis points to 244. On 10s up 5 basis points. We advanced. We took out 177 earlier in the session. On 10s right now, 175.45. Outside of this, into the equity market we go. Underperformance comes from the NASDAQ. Outperformance, relatively speaking, comes from the Russell. We're down just 0.1% on the Russell. On the NASDAQ, we're off by 0.6%. The reopening of this economy and the data we can expect can be absolutely stellar. Tom, I'll just set things up here. We'll skip the rest of this and get straight to this point. Bank of America looking for growth north of 7% this year, in and around 5.5% next year, and 1 million payrolls growth on Friday. The data is stellar, and you can draw a line back to what they see in the credit card spending data, which is just absolutely massive.
It is the micro data that leads to the macro call, and Ethan Harris joins us right now, expert at the macro call, but using the resources of his Bank of America, where he's head of global economics. Ethan, what I do is I look at the parlor game of 1-year guess or 2-year guess, and I take a considered Ethan Harris average. That's what Michelle Meyer does, and I come out with a Chinese economy. You guys have 6.25% economic growth spread out over 24 months. That is a Chinese equivalent economy. How will America adapt and adjust to this if we have an economy that's not structured like China?
Well, we can't grow at that pace indefinitely. I mean, this is just a huge fiscally fueled recovery, fastest recovery in history for the U.S. economy in the next 2 years. And eventually we have to slow down. And so, by the time we get to 2023, there's going to have to be some changes here. The Fed's going to have to pull back a bit. We can't really afford to continue to do trillion-dollar fiscal packages every year. We can't grow at Chinese rates. We don't have the population. We don't have the catching up to do on new technology that China has. But we can get 2 really robust years in a row.
Ethan, I've been looking at the card spending data that you produce in your reports, and I just wonder for you, 1, what are you seeing right now? And 2, how useful has that been just to have every twist and turn spelled out for you guys just ahead of time?
Yeah, I mean, we aggregate the data, so obviously we don't know anything about the individuals involved in this data. And it's turned out when you can match it up to policy changes like the rollout of stimulus checks and how that impacted households who got those checks. And what you found was that the stimulus checks really boosted spending a lot. And it's one of the factors that convinced us to get even higher above consensus on growth with consumer spending, we think, in the start of the year at almost 12% annualized rate. So the stimulus check really have put a lot of caffeine into the economy.
Unreal numbers. Ethan, just forgive me, just give me a couple of minutes of your research for our audience. Lisa, look at this, 7 days ending March 20th. Now, you can do the year over year and you can look at the base effects and we're up 45%, but just look at 2019, the last 2 years. 2019, or rather 2020, 2019 into 20 versus 21 right now. We're up 23% on a 2-year basis for retail sales. Looking at the credit card spending that we got out of Bank of America, these numbers are huge.
But when do we move from recovery and just making up the lost ground into something more sustainable, and that's something that has perhaps longer legs, adding to employment, adding to inflation over the longer term? And Ethan, it seems like the consensus is this is a momentary blip. Morgan Stanley saying it'll burn hot and it'll burn short. Do you agree, or are there longer lasting legs from all of this spending that could bleed into a faster economy for an even longer period of time?
Well, I mean, it is true that we're not going to grow at 12% every quarter going forward, but the fade in growth is not going to be that dramatic. We think by the end of next year we'll be growing 4% instead of 12%. That's still a great number by historic standards. That's double the normal growth rate of the U.S. And the reason we think there's legs in this is because they're going to continue to roll out fiscal stimulus. We're going to get another 2 or 3 trillion spread over the next 4 or 5 years. And the Fed got both feet planted in the accelerator, keeping interest rates at 0 in the face of a strong recovery and rising inflation is very stimulative. It's unprecedented. So I don't agree with this idea of a short run kind of caffeine high that then goes away. I do think we slow down, but we slow down to still strong rates.
This is a really important point, and you raised an issue of ongoing fiscal stimulus. How much are you thinking about these checks, not maybe $1,400, but still checks being sent to Americans as being the precursor to some sort of universal basic income, some sort of ongoing payments, and that the evidence of the spending that John was just talking about being used to justify that kind of plan?
Well, you've got elements of this already in the various plans out of the administration. So we've already seen an increase in the child care credit just for the next year, but it's very likely that's going to be extended. So there are going to be elements of trying to support moderate income families that are developed on a sustained basis. I don't think we go to some of the more aggressive, broader proposals around kind of guaranteeing incomes at certain levels. I don't think we get to that, but there's a lot of progressive elements to this stimulus.
And Tom, here is the conundrum, in my opinion, when it comes to inflation, which is such a key issue for markets. The idea here that if we start getting payments directly into the economy on an ongoing basis, could that fuel an inflationary push that perhaps people are not factoring in? And how much does this finally lead to wage inflation that we have not yet seen?
Well, the wage inflation question's there, and we'll get that evidence on Friday. Dr. Harris, I want to go back to Columbia University, and particularly to the engineering work at Clark University that was hit over your head at a young age. And it goes back to systems analysis and the idea of many people that there has to be a cost, there has to be a price to any zero-sum system. How do you have a boom with all the benefits of a boom that we're all hoping for, and have that emotion of there's got to be a price to this down the road? What's the Ethan Harris price that we will pay?
Right. You just gave my whole resume away there. Thank you for that. So in the short run, we can afford to have big budget deficits. We need to get the economy out of this hole. Unemployment rate's still over 6%. But the problem is that while you can kind of have, your cake and eat it too during a recession and do this dramatic stimulus, once you get into a full recovery, now you're competing for resources between the private sector and the public sector. And if you keep on rolling out big stimulus money and financing it through the bond market, you're going to starve the private sector of capital. And that's where the danger comes. It's not right now. My concern is, we get into a fully employed economy late next year, and nobody kind of sees the stop sign there, and we don't slow down at all. And then we get competing resources, we get some inflation, we get some crowding out of private investment. Those are the costs.
What's fascinating, Ethan, about this, and brilliant analysis, is that versus a closed economy versus open economy. If we get to a capital allocation moment, 2023, 2024, we do that in a global economy. Does that leak out into the global system?
Yeah, I mean, we are going to be driving the global economy in the next couple of years, to a lesser degree, China as well. We're going to be buying a tremendous amount of imports. So we're going to be exporting a big chunk of our fiscal stimulus. And we're going to be relying on foreign capital to help fund our economy. And so, that's not free money. That's money that you owe to the rest of the world. And so there's a growing indebtedness the U.S. to the rest of the world as we continue to borrow like crazy. So we're going to have bigger trade deficits, sustained high budget deficits.
Right.
This isn't a free lunch here.
Yeah, John, this is so important. It goes back to Bill Gross years ago talking about the locomotive of the system. And as Dr. Harris says, there's no question the U.S. is a locomotive front and center.
Oh, very much. You can see that in the data at the moment. The recovery in China has already matured. You see it in the credit impulse data as well, Tom. Ethan, we've got to leave it there. Ethan Harris, Bank of America Securities Head of Global Economics. Sir, thank you. And let's just sit on the research of Bank of America just for a moment and look at some of the numbers. 7% GDP growth, that's the estimate for this year. Tom, 5.5%, that's the estimate for next year. Payrolls growth this Friday. Michelle and the team looking at a million. They're near top of the pile. Just huge numbers.
We didn't even, it was my fault. We didn't even really get to that. That's an unimaginable number. And what I find from the optimists like Neil Dudd at Renaissance is they sustain out that million to get to a 7 million job ad, out to the end of the year?
See you again in April. See you again in May, Lisa. See you again in June, maybe.
The interesting thing to me, Bank of America actually very different from Morgan Stanley, saying not necessarily burning hot and then burning short, but that there could be legs. And that, to me, raises some questions about inflation, not necessarily going to the 1970s runaway inflationary, discussion point that some people are talking about, just more inflation. And what does that mean for the bond market and where valuations are now, John?
700K, if anyone's interested, Lisa. You mentioned Morgan Stanley. Alan Zentner and the team looking for 700K this coming Friday.
Huge.
The median estimate, 650,000. And I'll go back to that credit card and card spending data of Bank of America that we had just the other week. Total card spending as measured by the aggregated card data increased 45% over 1 year. Yes, there's a huge base effects issue there, Tom, but 23% over the 2 years for the 7 days ending March 20th. And it just gives you a feeling of flavor, a scent of what's still to come from this economy as we reopen and send checks out into the post.
John, can I tell you what I've been doing all morning?
What have you been doing?
I sit here,
I'm not sure.
I'm doing my taxes.
Slightly worried considering that we've been doing a show together for the last 3 hours.
I'm doing my taxes. I just got the bill in from Motel 6 at LA. It's just shocking, that itemized bill.
Okay.
John, I've been looking at MS Equities CN Go. I just keep going back to MS Equities
Looking for a statement from Morgan
which is the
Stanley
news
on the
flow
Bloomberg.
of. I'm sorry, folks. That's what I'm doing.
Can I ask you, Tom, how is the airport? Was it completely crowded?
It was really good. I learned a lot on this trip, and major shout out to Delta Airlines for just yeoman's effort there and back. The airports had a pop to it. Everything had a pop to it.
Why are you encouraging this, Lisa?
It's kind of fun.
Coming up.
From Terminal 2 at LAX to Motel 6.
Time.
On Bloomberg TV.
Right.
Yeah, Goldman Sachs Chief U.S. Equity Strategist David Costin. What a morning for it. He'll join us in about 20 minutes' time. From New York City this morning, good morning.
I met Tyler, the creator.
It's good to have the team back together. And a bit of support, too. Lisa's back. I'm happy about that. This is Bloomberg.
You weren't happy about me back.
With the First Word News, I'm Rishka Gupta. Germany plans to reassess the use of the AstraZeneca vaccine after reports of more blood clots. According to Reuters, the country's vaccine regulator says that 9 people have died from a rare blood clot after taking the vaccine. On Monday, Canada suspended use of the AstraZeneca shot for people under the age of 55 because of concerns about those blood clots. BioNTech has now raised the number of coronavirus vaccine doses it plans to make this year by 25%. The new target, 2.5 billion doses. BioNTech and Pfizer collaborated to develop the vaccine. BioNTech estimates that in the fourth quarter it took in $405 million in revenue versus $33 million a year earlier. President Biden is planning to take on the nation's challenge of inequality with a mass expansion of government spending. The president also plans a revamp of the tax code. He'll start to outline his plans tomorrow in a speech in Pittsburgh. The president's remarks will lay out the infrastructure part of a $3 trillion spending package. Social spending programs will be unveiled next month. The immediate crisis of the Suez Canal blockage has ended, but the battle over damages is just beginning. It's estimated that the cost of the canal's closure was $10 billion a day. Cargoes delayed for days, if not months, and that's likely to lead to a flood of claims by everyone affected, from the shipping lines to manufacturers and oil producers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
90% of the world's trade travels by sea. At any given time, around 5,000 ships are on the ocean carrying containers. Without them, the global economy would collapse.
Many of those containers pass through here, Singapore, the world's second largest port. The industry accounts for 7% of the country's GDP.
But the industry is under pressure. The uneven recovery from the pandemic is creating a shortage of containers where they're needed most and driving bottlenecks at major ports. It sent freight prices soaring.
Since the beginning of COVID-19, these are levels of shipments that we've never seen before.
Chinese New Year marks a seasonal turn for freighters when rates are renegotiated for the next year. Companies must choose whether to swallow the financial hit or pass on the cost. It's a decision that could bring new headwinds for the global economic recovery.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Surveillance. We welcome you on radio and television. Lisa Bramwitz and Tom Keene. John Farrell migrating to a next hour of coverage of what we see, which is a banking. We're waiting for news on this margin call, this banking story that is I'm going to give it a global nature. I mean, Lisa, we started with MUFJ in Japan and Tokyo this morning, and then we go over to further billions at Credit Suisse. It's global.
And there's a question of whether the trade has been completely unwound. People do say, sources close to it have been telling Bloomberg reporters that they are mostly done with the selling. However, Tom, this raises questions about the amount of leverage in the system that perhaps isn't being tracked in over-the-counter derivatives. And that continues to be a question as we deal with a very hot market after a long time of very low interest rates.
And the history of this, folks, is there'll be others out there. I don't put too much in that, but yeah, it's there, the thought that could it be just one family office / hedge fund. To get perspective on this, we rip up the script and talk to one Barry Ritholtz, who remembers where he was the third week of August, 1998. He remembers where he was with an Irish collapse of, I believe it was 2008. Barry, we have seen this before. It is greed folding into success and then folding into additional leverage. Barry, Robin Wigglesworth in the FT talking about 20 times and 8 times leverage. You can't succeed with that leverage, can you?
Well, if you're a hedge fund and you have to meet a monthly bogey, it's very challenging to succeed without leverage. Let me point out 2 things. First, everyone wants to reference long-term capital management. They were at 100x, so 20x, relatively speaking, is almost rational. And second, is there any field beyond finance, besides finance, that has demonstrated such an inability to learn from history? It's shocking.
It's shocking when we see that. And I go back, Barry, to Fooled by Randomness, Nassim Taleb talking about the Russian roulette. And he said the math that we get wrong is the simplicity of a gun. And the reality is it's a 1 in 1,000 collapse. That's sort of what we've seen here, which is you go with success until it doesn't work.
That's right. You know, I jokingly reference that if you set the speed record on the straightaway and you have the fastest time, but you can't make the turn at the end and you hit the wall and explode into flames, you shouldn't get credit for setting that record. You have to be able to navigate the turn. And we've seen this time and again when people embrace risk, when they ignore managing the potential downside, when they leverage up. Leverage is fantastic on the way up, but it's hideous on the way down. And this is one of the oldest lessons in finance.
And Lisa, what's so important here, from Taleb of Fooled by Randomness to the Black Swan to the skin in the game of Anti-Fragile, is you wonder what this family office had with skin in the game. The answer is they didn't. They passed off the ownership to the prime brokers.
Yeah, they didn't have a lot of skin in the game, and it was allowed by the prime brokers. On the other hand, and Barry, I'd love you to weigh in on this, some people might argue that the Fed is encouraging people to do just that, to lever up, whether it's a company that's borrowing a ton of money or whether it's an individual fund that can't earn their bogey with a 1.5, 1.6% treasury yield in the 10-year. And they have to lever up, or they're encouraged to lever up with cheap money on the front end. I mean, how much do you view this as just a side effect of the ongoing policies that we have coming out of Washington, D.C.?
Not really, you know. None? How about none? Because there are 11,000 hedge funds that did not blow up, and this is the exception that proves the rule. If the vast majority of participants with access to capital, with access to low rates, access to infinite amounts of leverage are more or less not over leverage, unless you're implying that this is the tip of the spear and we're going to see a ton more of this.
I'm not implying, because honestly, I don't know. And I'm asking, you know, and I'm raising the question because we're looking right now at leverage ratios that are still pretty high historically among U.S.-based long-short hedge funds. I was looking at one statistic that as of March 23rd, these long-short hedge funds are actually underperforming, number one, because a lot of them were in some of the more crowded trades. And their leverage is still about 201%, which is only 9% lower than January's high, which was the highest in a decade. I mean, doesn't this raise a question about what happens if we do get a more material disruption in markets that does spur some sort of unwind on a more holistic basis?
Sure. Listen, that's always a risk. That's always the possibility that you know, a large group of highly leveraged funds are going to, similar to the quant quake back in 08, if everybody has a very, very similar book if they're all exposed to similar things. I'm not sure that this environment is conducive to that. What we saw back in 07, 08 was there were so many things moving in a specific direction. It's not a surprise the quants were all similarly exposed. This smells like a one-off. I mean, I'm not sure if this is the first cockroach and there are a lot more out there. It seems to be very, very specific, spreading out all that leverage amongst a lot of different prime brokers is kind of the interesting systemic issue that's raised. And I'm wondering what the fallout from that's going to be. Are the various prime brokers going to start enhancing their coordination so they can avoid, I don't want to say being duped, but they can avoid having lots and lots of exposure to a specific over-leveraged fund? I don't know how much they're actually doing that now, but I wouldn't be surprised to see more coordination to make sure they don't have similar exposure to one highly leveraged hedge fund.
A brilliant idea. It is so competitive out there, Barry. I really have trouble seeing that. Barry Ritholtz, Bloomberg Opinion, writing in a must-listen podcast. I'm sure in the coming weeks and months, Mr. Ritholtz will address this disaster for the banks on his acclaimed podcast. Lisa, what an extraordinary moment it's been since Thursday.
Indeed, and I will say, to your point, very good point, about how difficult it is for the banks to work together. The reporting.
I don't buy it for a minute. I don't buy it for a minute.
And the reporting overnight about how banks were at each other's throats and basically went against each other because they basically were saying, let's coordinate these block sales so that we don't end up with a free-for-all and plunging prices. And that didn't work, right? And then Goldman Sachs and Morgan Stanley, according to this reporting by Bloomberg, went ahead and said, okay, we'll sell first. Nomura Credit Suisse didn't, and they got left on the hook as a result.
I've had the honor of speaking with the laureate Myron Scholes not once but twice about his experience in 1998 as an advisor and indeed some equity interest, I can't remember, in LTCM. I don't see the equivalency here. Then it was, Lisa, the banks all meeting except Bear Stearns in saying we got to get together to fix this.
Yeah, some people might view this, frankly, as a testament to the strength of the financial system. The fact that even with billions of dollars potentially of losses, the financial system is not at risk. Nobody is that worried about contagion. You can see that in the very calm price action today. And that perhaps is testament to the high capital withholdings that a lot of these banks have.
It's testament to being in the triple leveraged all cash fund.
Is it?
It's just a wonderful,
triple leveraged, huh?
It's a wonderful way to. My prime broker just loves it.
I was about to say.
Triple leveraged.
Are they coordinating with one another?
Yeah, it's a moneymaker for them. I'll tell you that. Futures negative 13, Dow futures negative 38. The VIX out 0.52 points, 21.26. Stay with us through the day on radio and television. My book of the summer, 2034, Stravitas at 12 noon.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
$177 on 10s from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now. Yields higher, equity softer. Your 10-year breaching 177 right now, 176. Let's get straight to it. We begin with the big issue, the Treasury sell-off making a comeback.
The narrative continues to push yields higher.
Joe Biden's spending everything he can.
The news on the vaccines.
A shift in expectations about the economy.
The good news is there's value being created. It's really the U.S. we're talking about. You wake up and you see another infrastructure plan on the table.
What can trip up the market is the rapidity.
175 was the first line in the sand. This is creating a tremendous opportunity down the road. I don't discount we could push on to 2% quite easily.
The next move up.
It is increasingly enticing.
What we are going to see is probably a lot more volatility.
Expect more bouts of extreme volatility.
This massive fiscal stimulus that Biden has launched.
That's going to be a blowout on deficits and debt.
The narrative will continue to push yields higher and the curve steeper.
Yields high this morning. Two things going on. Let's get to the other picture, the other story this morning, and cross over to Ed Ludlow. Morning, Ed.
Yeah, good morning. What we're watching is Starship SN-11 test flight, Boca Chica, Texas. The vessel will travel to a height of around 10 kilometers, 6.2 miles, the point of apogee, where it will then slow itself by reducing the thrust on the different three Raptor engines, start its descent back down to Earth, then do the belly flip. You'll be familiar with, John, the belly flip, using basically the resistance in Earth's atmosphere to slow itself down until it continues its ascent. This is a fully autonomous process. All of the onboard computers will make the calculations. And the bigger question is, why is SpaceX doing this? You know, the last time SN-10 was the first time that they did actually land the vessel, but a few minutes later it burst into flames. It's all about data gathering. These are sort of incremental steps to a much bigger plan, which, as you know, John, is to get a vessel to Mars, and not just get a vessel to Mars, but to get Starship to Mars with human beings on board. So while, you know, these are incremental tests, some of them a success, quote unquote, because they land, some of them end in a fireball. That's not really what SpaceX is trying to do here. It's trying to gather data to improve the onboard flight system, to improve the measures of thrust that it's using in its Raptor engines, and through that, longer term, probably in around 2025, that's when Musk is aiming for. They want to send a crew to Mars and an unmanned test flight to Mars in some point in the next 2 years.
So, Ed, I know you're going to continue following the pictures for us, so do that and stay close. If anything happens, keep us up to date. Let's get back to the main story in this market this morning and head to the Bloomberg team. Kevin Cirilli, Kelly Lyons joins us now. Kevin Cirilli, $3 trillion, a big proposal coming in the next 24 hours.
3 points that I would make here. First and foremost, division in terms of how to pay for it. White House Press Secretary Jen Psaki says that President Biden will announce some pay proposals in his address tomorrow in Pittsburgh. Secondly, in terms of taxes and raising taxes, the corporate tax rate is going to be proposed to be increased from its current level of 21% to 28%. But then thirdly, and this is an important point here, this is just an opening bid. From the reporting that I've been able to glean from the past 24 hours, Republicans are very skeptical of this. And I point to this because when you look at the window of opportunity for a $3 trillion proposal, it is increasingly closing on a massive singular legislative effort to be pushed through with that type of price tag, John. But I would go one step further. If the administration, and I'm hearing that they could take this route, does a more piecemeal approach, then yes, there are components of what the president is going to be unveiling tomorrow in Pittsburgh that could actually garner bipartisan support, especially in terms of digital and national security.
Kevin, a lot to get through this morning, sir. A lot for you to digest in the next couple of days, too. Kevin's already there down in Washington, D.C. Let's head now to Kelly Lyons for a little bit more on this and the price action in the bond market. Kaylee.
Well, John, Treasuries are trying to digest the prospect of another $3 trillion in stimulus coming on top of the already $5 trillion in fiscal spending that we have seen since the pandemic began. Of course, that $5 trillion number you have to compare with just $830 billion spent during the financial crisis. So you have to take all that optimism about trillions of dollars of spending either on the way or already hitting the U.S. economy and pair that with optimism surrounding the vaccination campaign. And what you get is a sell-off in the bond market. Yields climbing higher today across the curve, most notably on the long end. We are up about 4 basis points on the 10-year, sitting right around 1 3/4%. That's the highest since January of last year. And of course, this isn't a story unique to today, John. The same narratives, fiscal spending, a pandemic recovery, have been driving yields higher throughout the course of this year. The 10-year yield up about 84 basis points year to date, the 30-year yield by around 80 basis points. Of course, the front end has stayed pretty much anchored thanks to the Fed, but for duration, it has been a painful first quarter. Of course, that period ends tomorrow. It will mark the third straight quarterly increase on the 10-year yield and the biggest advance for that yield in more than 4 years, John.
Kelly Lyons, thank you. The outlook looks brighter. We're talking about a $3 trillion fiscal plan. Got to talk about tax hikes too, and what it means for this market. That was Kelly Lyons. Let's bring in David Costin at Goldman Sachs now, the chief U.S. equity strategist, for a whole lot more on this. David, can we start there? On the tax hikes, do you just reach for the 2017 research and reverse engineer it, or is it more complex than that?
Well, the market certainly is not traded that, John. What you saw in the 2017 situation was it was all the way almost to the end of the year. It was December 22nd when the legislation was passed, and the market really didn't trade that until just before it. And really, it took about 2 months following the legislation to pass for that to follow into the equity market. And the stocks at that time, with the highest effective tax rates, rallied significantly. We haven't seen that. So the market has not embraced it. And I heard in your earlier session, people talking about what may be proposed tomorrow by President Biden. And that doesn't necessarily mean what will actually transpire and pass as legislation perhaps later this year. And so I think it's a little early to trade this. But yes, John, you definitely want to look at that as a playbook. There's certainly a list of companies that would be potential beneficiaries, or on the other hand, potentially hurt from a financial point of view as a result of the higher tax rate.
That's the approach, David. I just wonder for you, the signpost you're looking for to start to say, okay, this is real. We need to start training on it. We need to adjust some of our calls.
Well, I think that's probably later in the summer. If I sit here today at the end of March and sort of look into the future, the expectation maybe the legislation gets introduced in the early part of the summer. These are just rough estimates, but later that would be negotiated probably in the fall. And so the lesson from the 2017 experience was really the specifics matter. And in this case, it's really, really important because is it the GILTI? Is it that global intangible tax that's going to be adjusted? Is it the statutory rate? That will depend on whether a domestically facing company or a more internationally facing U.S. corporation has benefited or is hurt more. So I think there's a lot of specifics actually matter in this case. I'll leave you with a couple of data points. If you took the Goldman Sachs earnings model, which we have right now, and you kept the same tax rate today and just kind of played that forward unchanged, you'd be around $202 or $203 for next year. That's not our assumption. We are making a baseline assumption that there will be higher corporate taxes, modestly higher taxes. And that would take you, in our published estimate right now for next year, 2022, around $197. However, if you took the full Monty, and you sort of took, say, what candidate Biden, when he was running for president, some of the things he was proposing, the earnings estimates for next year would be something like $185. So I've sort of framed for you 202 at the top, 185 at the bottom, kind of in that range would be no changes on the one hand, full changes on the other hand, and somewhere in the middle is probably where you end up, just like everything in politics.
Will you forgive me to get a little bit more granular, just a little bit, David, because I'm wondering, the high taxpayers, the ones that would get hit by a high corporate tax rate, I'm wondering where you find them. If they are found in some of the cyclical plays that people are loading up on going into summer, do you find them there?
well, you're generally going to find them with more of the domestic-facing revenue sources, number one. Number two, actually on Bloomberg, we trade a basket of companies with high effective tax rates relative to low effective tax rates. And I said earlier, when you look at what is or has not been trading or has not been trading, that's the way we think about that. So domestic-facing revenue is probably the most prominent, easiest way to think about that. Ultimately, it's going to make a big difference, again, on this international versus domestic, depending on how the congressional legislation actually gets written.
So I want to turn to what you've been focusing on as well, David, more recently too, and it's the rising input costs and what it could do, or maybe won't do, to profit margins as well. I know the basic call from you and the team at Goldman right now is, yes, expect contracting multiples, but earnings growth is going to be stellar. David, can you just walk me through a couple of those points?
Well, so you do have the rising input costs. You hear that when I talk with chief financial officers, ships not just in the Suez Canal, but actually in the Pacific Ocean, where they have difficulty unloading these bottlenecks, if you will, in the ports on the West Coast. So that's, if you will, some infrastructure or the sort of input costs there. The labor costs, higher pressures there. So those are sort of some of the concerns you have on the sort of cost basis. You have the highest degree of operating leverage we've had in U.S. corporates for the last 10 years. And so that's the rationale for why we expect those companies to continue to do well. But John, the most important issue that's out there right now, of course, is rates. Earlier you mentioned, you referenced that. And the trade of the year has absolutely been in the equity market to shorten duration. The shortest duration companies, where the average amount of time in the future that your cash flows are received, John, those companies up 22% year to date. Long duration companies, longer in the future, those stocks down 7 percentage points. That's nearly 30 points.
Unreal.
Relative outperformance. So the shorter duration is what you want to do in a bond market when the rates are rising, and that's kind of what you want to emulate in the equity market. It's more important than the cyclicals versus defensives, which is also generally done better. Some of the cyclicals have shorter duration, but I'm talking about short duration, John, across all sectors of the market.
Just fascinating, the relative performance you get, David, just breaking it down like that. Looking at it a little bit further, can we just finish on this, the kind of companies that you want to own? And I'm looking at the breakdown from your research, and I know you can't do single names, but I just want to bring it to the audience, just to understand the kind of names. Looking at financials, we're talking about American Express, Regions Financials. I don't see the big names on Wall Street in the mix here. In IT, I'm looking at names like Visa. I'm looking at NXP Semi as well. David, what do all these names have in common across various sectors that you want to own going through the rest of this year?
But generally speaking, as I said earlier, the idea of rising interest rates is sort of central to a lot of the conversations we're having with clients. It's a reference to the amount of fiscal stimulus that's happening, concerns on the part of fund managers about potentially overheating, higher inflation, steepening yield curve, all those issues. Then when you translate that conversation, John, into the equity market, the idea of owning companies with shorter duration. They tend to be a little more cyclical. Within every, I think the important issue is within every sector of the market, within every industry group, there are some stocks that have shorter duration, their near-term cash flows. I think what is most concerning is these I call them the glamour stocks, where there's actually losses happening now, but there's tremendous sales growth. And the sales growth is what gives the enthusiasm of the investors, but that means their cash flow, average cash flow duration is into the future. And those companies, if you will, are most vulnerable to a resetting of the valuation of those companies. So I think that's kind of areas to be avoiding, and the ones to own are where there's more visible cash flow near term.
David, always great and fun to work through some of these issues with you. Come back soon, won't you? David Costin there at Goldman Sachs. Thank you, sir. Coming up, more banks bracing for losses as the block trade fallout drags on. That conversation still ahead with Morgan Stanley's Lisa Shallett from New York City this morning. Good morning. 17 minutes away from the opening bell in a beautiful New York. Futures down 12. We're negative 1/3%. This is Bloomberg.
minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Friday, a Bloomberg Television exclusive, a conversation with Baidu co-founder and CEO Robin Li.
We're far from done. We will continue to invest for the next 10, 20 years.
Watch the full interview only on Bloomberg Television.
Certainly in the U.S., with the financial system here, whether it's the large banks or others, I think they're extremely well capitalized right now, have a lot bigger cushion against events like this. But it does reinforce there's risk out there. You've got to know the firms you're dealing with. You have to understand the leverage that they're utilizing to do their business strategy.
Bank of America's vice chairman reassuring investors following the implosion of Archegos Capital Management. Financial regulators also stepping in, trying to find out what led to the biggest hedge fund blow-up in years. The SEC saying, quote, "We have been monitoring the situation and communicating with market participants since last week." For more, let's bring in Bloomberg's Sonali Basak. Morning, Sonali.
Good morning, John. Remember, every bank had a different set of exposure to the Archegos situation. We had some of the biggest international banks saying they're going to take billions of dollars, if not hundreds of millions of dollars worth of a hit here due to this situation, right? You see Credit Suisse's investor, David Harrow, coming out and saying that this was really an issue of poor risk management. Why were these banks either so slow to sell after the initial hiccups were targeted? And separately, there's another issue here, John. It's, did these banks communicate on the onset? These banks didn't know what was on the books of the other banks to know how much leverage Archegos had taken on in the first place. Regulators will want to know questions like that. What was the collateral behind these trades? What was the financing terms behind the leverage that Archegos was taking on? At the end of the day, this will be an international regulatory story, right? We have the SEC taking a hard look at this. My sources, John, say that they have some skepticism here because in this world of the swaps market, it's the SEC's role, it's the CFTC's role, and at the end of the day, it ends up being a big tug of war. At what point will we see Janet Yellen also enter the situation and make this an FSOC matter, given really this is the third major issue in the hedge fund industry in less than 18 months?
Sonali, some really uncomfortable questions that need to be asked here, whatever their opinion of what happened actually is. If you think about it, is it conceivable that prime brokers didn't know what leverage this particular fund was taking from other prime brokers? Okay, if they didn't, why didn't they? There's question one. If they did, what on earth were they doing? That's follow-up question two. Sonali, either way, it doesn't look good, does it?
No, it doesn't look good. And again, swaps can be a very lucrative market, especially for the largest of the prime brokers. If you're Goldman Sachs and Morgan Stanley, you've proven here that you can get away with this without any dark marks, right? They were able to navigate the situation effectively with minimal losses to their investors. But if you're Credit Suisse and Nomura and MUFG, then you really have to start answering some tough questions about what you were offering Archegos and why.
Sonali Basak on an important story and no doubt working the phones into the later hours of this evening. I want to bring in Lisa Shallett now of Morgan Stanley Wealth Management. She joins us. Lisa, I think we've got to start here, and I'll try and do this delicately because I always try and keep my guests out of trouble. As you know, I won't make this uncomfortable. But once we see one fund blow up like this and begin to deleverage, do you get the sense that we might see a theme emerging here? And other funds will have to have a look around, other prime brokers will have to have a look around soon, and we actually see broad-based delevering?
John, obviously a good question and good morning. I think if we were going to see that, markets are very smart, and this has been a issue that's been playing out over the last 4 or 5 days. I think the fact that markets overall are hanging in here really do speak to the fact that this, unlike some of the other issues we've seen historically, is not of an order of magnitude where there's systemic risk. I think, I think market action and the wisdom of crowds has told us that. And so now, clearly we're going to have to see the shakeout and see if there's, idiosyncratic exposure to some of these players. But I don't think that this is interlinked, with a lot of other things in the financial system.
We've got to ask the questions on whether there's a bigger story out there, Lisa, and whether maybe the boat's too loaded to the one side. This happened in a pretty calm market environment. It didn't take much to blow up a big fund with a huge position. And Lisa, I think that's the question a lot of people are asking themselves this morning, whether the boat is too loaded to the one side, whether this is just a product of a market moving in one direction, not necessarily because of low rates, just a one-direction market, which has just ended up with a lot of leverage and a bit of fragility.
Yeah, look, I think you used the exact right word that we would echo: fragility, right? This is a market where, the Fed has made it clear that they are going to keep their foot on the accelerator the whole way. And that means that wherever you have excess liquidity, the potential, for accidents goes up. And we're seeing that whether, we're looking at speculative behavior potentially in, SPACs-oriented markets, speculative behavior in crypto-oriented markets, speculative behavior in some of the retail trading-oriented channels. These are all examples, and I think along the way, the Fed has made a bet that the power of that liquidity for the aggregate economy is going to be bigger than the potential smaller little financial accidents or bubbles that have popped up along the journey here.
Lisa, I always appreciate how well aligned the views are over at Morgan Stanley. And at the moment, it's this cycle called shorter, hotter, and maybe a cycle where rates don't actually climb higher at a policy level. Lisa, from a market's perspective, how important is that dynamic for capital allocation decisions going forward?
Yeah, so we've said that this is, extraordinarily important, and that it's really time for investors to retool portfolios. The portfolio that worked in the last cycle, which was a low growth, low capital investment, low productivity, very long cycle enabled by very, very low interest rates, where the Fed was the only game in town, was a passive portfolio. It was a U.S.-centric portfolio. It was a growth-oriented portfolio, right? And those attributes are not, I think, what we're going to see in this hotter, shorter cycle or this boom-bust period. And so, not unlike some of the commentary of your last guest, David Costin, we're suggesting that people move to a very different portfolio, a portfolio that's actively managed, a portfolio that's much shorter in duration, which by definition on the stock side means much more cyclical, that has quality and valuation support attached to it, and is really leveraged to what is really going to be different this cycle, which is economic growth. Economic growth this cycle is going to be much stronger. And that's good for cyclicals. It's good for the labor market, but it's going to be a tough headwind, not only for the bond market and inflation, but for stock multiples. So, we are looking at a very different portfolio.
Lisa, good to see you. As always, Lisa Shallett there of Morgan Stanley. Need to turn some breaking news across the Bloomberg. Germany to recommend the Astra vaccine and the use of the AstraZeneca vaccine only for plus 60-year-olds, so 60 plus. Confusing headlines around this vaccine coming across the headline. We'll update you more on that as that story develops. Coming up, the analyst action you need to know. That'll be next in our morning calls from New York. This is Bloomberg.
right now about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Five minutes away from the opening bell in New York City this morning. Good morning. Futures down 10. We're negative 0.2%. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Credit Suisse, upgrading Viacom CBS to neutral from underperform. The analysts seeing near-term catalysts for the company from government stimulus and improving pay TV subscribers. Morgan Stanley lowering its price target on shares of Snap to 74 from 85. The analyst expecting tactical volatility around valuation, but saying he still sees strong long-term growth drivers. And finally, Truist raising Roku to buy from hold, cutting its price target to 367. The analyst expecting upside from the company's platform business and saying it should benefit from growth in video advertising and content distribution.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
25 seconds away from the opening bell in New York City. Here are the scores for you. Going into kickoff, futures down around about, where are we? 11 points lower on the S&P 500, off by about 1/3 of 1%. On a Russell unchanged, your underperformance comes from the NASDAQ, and your why, well, maybe it comes from the bond market. There's your opening bell. Switch up the board into 10s we go. Your Treasury market looks like this. Yields are up by 3 basis points now, 174. Took a little look at 177 earlier, then pulled back. In the FX market, euro dollar down to 117.22. Just about holding on to a 117 handle. We're down 0.4 of 1% on that currency pair. Dollar index with a 93 handle, of course, heavily weighted to the euro, the single currency, and crude's down 2 percentage points, $60 on WTI, $60 and about 35 cents. So that's the cross-asset story this Tuesday morning. Let's get to the market desk and get your movers. Here's Abby.
John, before turning to this morning's big story and the influence of rates on the various sectors, let's start off with yesterday's story, the blow-up of that hedge fund and some of the names linked. Because today we have a bit of a bounce back for the likes of media companies Discovery and Viacom. We also have VipShop, the Chinese discount internet retailer, soaring. This may suggest that some market players believe that Archegos unwind is done. Let's see. As for rates, they are higher, as you've been mentioning. The 10-year yield close to 174, its highest level in more than a year. That's pressuring big tech. Folks worried once again that big tech could be the valuation come into question, plus the idea that it's last year's trade. However, where do we have rates rising helping? Not surprisingly, banks. We have the big banks higher, plus also getting a little bit of a bounce from that Archegos, the situation, the possibility that it's unwound. Folks really relieved, particularly for Goldman Sachs and Morgan Stanley. Those stocks yesterday, John, had been under pressure, but again, rising rates helping the financials. That's the story, as you know, this year.
Very much so. Abby, thank you. The price action this morning, fairly intuitive. The S&P 500 down 0.25%. Bottom of the pile, energy, WTI getting whacked. Financials, they snap back up 0.8%. Abby's run that through for you. In the IT segment, that sector is off by about 0.75%. Yields higher across the Treasury curve, particularly at the long end earlier on this morning. And we ask the same question every time we see that. Is the Fed comfortable with it? Well, the Fed's pushing back on expectations that it might step in to keep rates in check. The Fed Governor, Chris Waller, weighing in.
Because of the large fiscal deficits and rising federal debt, a narrative has emerged that the Federal Reserve will succumb to pressures, one, to keep interest rates low to help service the debt, and two, to maintain asset purchases to help finance the federal government.
Let's bring in Bloomberg's Kelly Lyons for more. Hey, Kelly.
Hey, John. Well, Chris Waller throwing cold water on that narrative that the Fed has a responsibility to keep higher yields in check. And really, he just joins a chorus of officials, including Chairman Jerome Powell, that have been reiterating that message again and again, that they are not concerned with rising bond yields. The action in the Treasury market, of course, got a lot of our attention given the velocity of the move we have seen this year. The 10-year yield rocketing from 91 basis points at the start of 2021 to now 1.75% at the end of March. We're talking an 85 basis point move since just the start of the quarter. Now, of course, many thought the Fed may have to step in to keep those higher borrowing costs in check, or at least they might talk things down. And instead, that isn't the messaging we've gotten. Time and again, we've heard officials say that the yields are rising for the right reasons, and therefore they aren't concerned. Of course, those reasons being higher growth and inflation expectations. We can see that reflected not just in nominal yields, but in break-even rates. The two-year break-even now sitting above 2.6%, of course, well ahead of PCE, which is the Fed's preferred inflation gauge. And as we know, the Fed thinks any inflation is going to prove transitory. The Fed has also said they'd only be concerned about the action in the bond market if it proved disorderly and tightened financial conditions. But to this point, even with yields moving higher, financial conditions haven't materially tightened. Yes, we aren't quite as easy as we were when we started the year, but still, relatively speaking, they are quite accommodative, John. So no reason maybe for the Fed to step in, John.
Kelly Lyons, thank you. Let's continue the conversation. Joining us now is Stephen Dober of Franklin Templeton, and Citi's Kristen Biddley with us as well. Kristen, this story of higher yields, right now, we seem to be able to cope with it. This move from 1% through 150 through 175, do you think that remains the case through the remainder of this year? I think we've got a problem with Kristen's microphone. Kristen, we'll work on that for you. Don't worry, we'll sort that out. Stephen, I'll come across to you, sir, and we'll continue this conversation. Stephen, just weigh in on that if you can. We took down 150 quite nicely. This equity market was okay. 175, this equity market is okay. Do you think that remains the case?
Yes, I think it remains the case. You just talked about the Federal Reserve. We tend to agree with the Federal Reserve that inflation is transitory. This interest rates going up is normal for this growth economy. What I think we have is stocks that are affecting to duration. Some of your previous speakers in the program talked about that. What's tied to that is leverage. The issue we have with the hedge fund is actually an issue of leverage. So we have some concern about those participants that are heavily leveraged as interest rates go up, that we might see some fallout from that.
Kristen Biddley, we'll try again. I believe you're with us. Go on.
I'm back. Hopefully you can hear me now.
I can.
So in terms of how we're viewing this from a rates perspective and an inflationary perspective, we are in the camp that we believe that it's transitory. We do think that the economy can actually function quite normally, right? If we go back to 2019, the end of 2019, the 10-year was at 190, right? And our growth prospects, looking at some of those sectors that have been hit year to date, so technology, we're actually functioning quite normally. So I think at the levels that we're at right now, and even kind of climbing to 2% and above, we should be okay. That being said, I think from a portfolio context, we have to be smart about this. If you see rising rates, if you see this curve steepening, if you're worried about inflation, what it means that cash is punitive and duration is punitive. So you need to make those portfolio decisions now to make sure that you're not going to have exposure, whether it's either to sectors that are interest rate sensitive or that you're basically achieving yield through alternative sources of yield to replace that income that you're not receiving in a very efficient risk-adjusted way.
Kristen, let's talk about the cash position just a little bit more. And then, Stephen, I'd love your view on this too. I've caught up with BlackRock twice in the last 24 hours. So they've increased their cash allocation and seemingly a little bit worried about dislocations and a bit more volatility through the summer in the next couple of months. Kristen, why do you think that's a waste to have that position just waiting there, to have that dry powder?
Yeah, the cash buildup on the sidelines, I mean, we've seen this for quite some time, right? So when you look at cash on the sidelines, the U.S. household, you basically have 16% of financial assets in cash. Saving rates are really high. When you look at that buildup, it's actually pretty significant. I think that one of the things in terms of actually putting that to work right now is, so you have some technical pressures and you also have this acceleration in terms of the economy is not reopened yet, right? You have 15% of the global economy that is still shut down. You still have people who I believe it's seeing is believing, right? So when we get data around the fact that by August of this year, any U.S. adult who wants to be vaccinated will be vaccinated, when you start to actually tangibly see that and then see the flows come into the market, that's going to provide some technical tailwinds that we expect to benefit. And so we believe that there's plenty of opportunities to put cash to work and not sit on the sidelines.
So, Kristen, just to be clear here, you're talking about the excess savings that we've built up over the last 12 months and maybe not the individual cash allocations of a fund manager per se.
Exactly. So the individual cash allocations of a fund manager are a little bit different in terms of saying, I'm going out of the market, I'm building up those positions in terms of the fact that I'm worried about volatility. We're in line with that we do expect elevated volatility. So the action that we've seen in rates is going to create additional volatility. We're going to see that tug of war in the market in terms of fundamentals and earnings driving the market, as opposed to maybe some of these mean reversion plays. But ultimately, we believe that there are opportunities to put cash to work and that it makes a lot of sense right now, even with the volatility.
Stephen, can you weigh in on that cash